in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Really interesting 2 hours coming up on Wall Street. Bank of America results just around the corner, then Morgan Stanley, and then US retail sales. Going into all of that, equity futures on the S&P 500, pretty much unchanged through most of this morning over the last couple of hours. We're negative now by 0.03%. We're down about 0.1% on the Nasdaq 100, which has outperformed massively to the upside year to date so far. Into the bond market, 2-year, 10-year, 30-year, shaping up as follows. We're down 5 basis points on a 2-year to 469.37. We're down about 4 or 5 basis points on a 10-year as well, 375.99. The bond bulls can thank Europe this morning. A couple of ECB officials not exactly endorsing a rate hike beyond July. And if the most hawkish officials on the ECB aren't committed to a hike beyond July, you wonder who is on the governing council. In the euro, though, it doesn't seem to matter. Nothing does over the last 9 sessions. 9 consecutive days of euro strength. It continues. The longest streak going back to 2004. Tom, the euro, 112.51.
It's impressive, and it's a pulsating thing. It's out to 4 decimal points to the right. I mean, it's a very, very subtle thing, but you're correct to identify this. And I would go across to us to a 10-year real yield of 1.51%. The same thing, the inflation or disinflation metric there, just pulsating a little bit lower.
The last week dominated by optimism about soft landings, encouraged by the recent economic data out of America. You heard that from Jan Hatzius and Goldman. You even got a glimmer of that out of the investment bank over at JP Morgan. But this is what Veronica Clark and the team have got to say over at Citi. Optimism around a soft landing is premature. Tight labor markets, elevated wages, upside risk to shelter and other services inflation means we do not share this optimism. Tom, absent a tightening of financial conditions, inflation may well reaccelerate in early next year.
Without question, the interview of the day for the present in new bulls. Veronica Clark is economist at Citigroup, working with Mr. Hollenhorst. Without question, they have been out front on market economics and looking for higher rates. Veronica Clark, let's cut to the chase. There's a new soft landing-ish out there. What do they get wrong? What is the singular distinction which allows you not to join the club?
Yeah, I think it really comes down to the labor market, and the data that we might see for the next, really for the rest of this year could look like a soft landing. We will probably get still some strong activity data. Inflation, especially by CPI, could look like it's slowing, but unless we get more loosening in the labor market, it's hard for us to see that inflation, durably, sustainably comes back to 2%.
What is the employment data that matters, and do we have to wait for the first Friday or whatever of August to get a recalibration here of which way this landing goes?
Yeah, it ultimately comes down to what wage growth does, really. But all the employment data is going to matter, of course. And when we have a very low unemployment rate and we're still adding, over 100,000, well over 100,000 jobs, that's still putting, downward pressure on the unemployment rate. That should mean that there's still that upward pressure on wages. And we'll be watching, the ECI that we're going to get next week. The Atlanta Fed has a wage tracker that is also still showing wage growth that's too strong to be consistent with 2% inflation.
Some people are saying that the reason why inflation is coming down so quickly is just because the year-over-year comparison numbers are so easy to beat. Can you give us a sense of which aspects of the inflation read could potentially regroup and reaccelerate in the next 6 months?
Yeah, I mean, that's definitely part of it, especially when we're looking at headline inflation and energy prices that have come down a lot. We will still see, falling used car prices probably in the next couple months. And of course, that's been a really strong component of inflation, and that will look a lot better. But components that we're focused on are still those core non-shelter services, shelter, which should continue to slow also. But even something like that is where we could see some reacceleration. We've already seen this rebound in housing activity. So we might see some of that upside later in this year and maybe early next year.
Our colleagues just caught up with Janet Yellen again, the Treasury Secretary, in an interview over in India. This is what she had to say, that the intensity of hiring in the United States, those demands have subsided. Just on the disinflationary dynamics in the United States, she detailed a range of them, citing the labor market, housing costs, used car prices, every reason to see housing inflation impulse dropping from here. Now, Veronica, just on one of the points that Secretary Yellen made, just on the labor market, this is still the debate, has been the debate over the last 12 months. Can we get inflation back to a so-called acceptable level, something on its way back to 2%, without significant softening in the labor market, which basically means can we achieve that without sending unemployment much higher than where it is right now? Veronica, do you think that's achievable?
Yeah, I mean, some of the data that we've had over the last year, it certainly looks like that could be a possibility, but I would still be pretty skeptical of that. We've had job openings that have come off their highs, but there's still about 3 million more job openings than there were pre-pandemic, and fewer unemployed people to hire. And we've had the quit rate that came down back to normal levels, but has actually ticked back up again. And of course, it comes down to wage growth, and that is still running, 5-6% or so, and that's still too strong to be consistent with 2% inflation.
Do you think that at this point, given the fact that a lot of the disinflation that we're seeing is a result of simply year-over-year comparisons and not necessarily a Fed policy transmitting, are bets of a soft landing at this point, in your view, the same as bets on immaculate disinflation?
Yeah, a little bit. That is, the ideal soft landing scenario for the Fed. We get maybe softer growth, but inflation comes down without this bigger contraction in activity. And I would really be cautious, especially around what we've seen in the housing market, where that is the most rate sensitive sector. And we did get activity slowing. We did get prices coming down some, but that drag from monetary policy seems to have come and gone. And we've gotten this rebound in housing, and prices have started to pick up again. So that could be somewhat of a cautionary tale as we're getting into next year.
Veronica, I'm going to go to where the Cincinnati Reds are. They're the most exciting team in baseball right now. So let's move to Ohio. The unemployment rate is 3.6%. Before the great financial crisis, it was 5.2, even 5.5% as well. Are you suggesting this is a Fed that wants to drive the Ohio unemployment rate back up above 5%?
No, they certainly don't want to, see a rising.
How can they have it both
rate,
ways then? I don't get
please.
this. I don't get the. I totally take your answer, but then how can you do what they want to accomplish?
I know. I mean, the Fed has acknowledged, of course, that maybe the labor market does need to loosen more. Their own forecast for unemployment rate at the end of this year is higher than we are now. It's about 4.1%. Obviously, they would prefer to not have a big contraction, but ultimately it has to come down to what does it take to get inflation lower, sustainably back to 2%, and ultimately that might need to be more loosening of the labor market.
The loosening of the labor market, doesn't that equate to higher unemployment rate?
Yeah, and that's the Fed's own forecast too. They do have a bit higher unemployment rate than we have now. It does become a question, how high will they be willing to tolerate, and maybe we'll see as we get there. But the next 6 months, I mean, they might look like they're on this ideal path to soft landing. It just might not be sustainable.
I was just reading through some of the comments that John was talking about with Janet Yellen speaking with our colleagues over in India again, and she's talking about some of the features that need to happen in order to keep inflation on this downward path. And she points to profit margins in a much more diplomatic way than Lael Brainard does, but she says profit margins are also quite high, and they have some cyclical dimension. So I don't want to go so far as to say you couldn't see inflation come down without further moderation in wages. Lael Brainard earlier said the companies need to bring the markups down. How much is this a feature of why inflation has been sticky?
I mean, I think in general, I mean, if we are getting this slowing in activity, you probably will see profit margins come down, and that is related to slowing of demand that will bring inflation down. I think it's maybe one of many components, but we might see some of that contraction if we do get inflation lower.
So, what's the most mispriced aspect of the inflation path in markets right now, from your vantage point?
I think really as we're getting into next year, the next 6 months. We probably are, we're expecting inflation to come down, especially if you're looking at CPI inflation. But maybe, the durability of that for next year is still a little bit, overappreciated. People are thinking that we'll get to something like 2% inflation and it will stay there. But I would be much more concerned about scenarios where, shelter prices are picking up again. Even a tight labor market, that means wage growth is stronger, and that could mean just general inflation is stronger for next year and maybe even beyond.
What is the Citigroup call right now on this present quarter of real GDP? I'm getting 2-ish. I guess I'm below 2-ish, but I'm edging towards, everything's an ish now, John. 2-ish. Are we near 2-ish?
We're near 2-ish, yeah, right around there. And we've been there for a couple quarters. Of course, 2%, real GDP growth is still pretty strong. That's not looking like even a soft landing. That's not even looking like just below potential growth. That's still activity that is still pretty strong.
Hey, Veronica, love the pushback, I've got to say. Keeps things interesting. Veronica Clark there of Citi, pushing against the soft landing crew of the last week or so following inflation data in America just in the past week, and looking ahead to 2024 and potentially anticipating a re-acceleration of inflation. That would change the debate on Wall Street, that's for sure. This morning, the focus is elsewhere. It's firmly on the banks. A little bit later this morning, in around about 5 minutes from now, we should hear from Bank of America, then on to Morgan Stanley, then tomorrow you'll hear from Goldman Sachs. In between, tons of smaller banks, so-called regional banks here in the United States reporting. Just moments ago, PNC. Alongside us, Shanali Basak, Bloomberg Wall Street correspondent. Shanali, good to see you. Good morning. Should we start with PNC this morning? What have we got?
We sure should, because you're seeing some of the macro challenges the banks are facing floating into PNC, because even though net interest income is slightly above expectations there and charge-offs are actually below expectations, you're still seeing revenue overall come in slightly light, and you're also seeing their expenses, their efficiency ratio, come in slightly high. So again, this is kind of one of the bigger of that mid-sized group here. They are going to be more bellwether for the challenges that the rest of the group face.
I'm sure Shanali, in their wonderfully clear statement here, net interest income declined 2%, net interest margin, NIM decreased 5 basis points as well. To someone like you, does that mean right-sizing right away? I mean, is PNC with a flattish story here, and maybe we'll see others like Western Alliance more challenged, does that mean the only one thing you can do is to cut costs?
Yes. I mean, how you cut costs is going to be of critical interest. Remember, costs are rising across the board in many ways, personnel being one of those ways. We've seen a lot of the pressure so far in the job cuts be in mortgage units so far, as well as investment banking. For PNC, what do you do when it comes to more personal bankers here, people who are dealing with more of the American society? By comparison, Tom, JP Morgan's net interest income for the first 6 months of the year rose 25%. Citigroup's rose almost 20%. So that's the difference between being the biggest of the big and being in the middle of the pack.
And just to put a bow on that, PNC Financial sees third quarter net interest income of about 3 to 4%. So just compare the two numbers,
Huge
completely
difference.
different ballpark. We're also seeing that the average loans in the third quarter were down about 1%. PNC was considered the most strong and the best positioned of the regionals. What does this suggest about some of the smaller, less well-positioned firms?
Well, this is the problem, because you're seeing the small and medium-sized lending, and you've seen this in the Fed data, so it shouldn't surprise anyone so much. It's now granular bank by bank, but loan demand isn't booming on its own. The businesses we've been talking about, it's credit card businesses that you're seeing a lot of money being borrowed from the banks. So it's not the kind of texture of loan that you're seeing from a bank like PNC per se.
What are you looking for? Is it going to be the issue of cost of capital for some of these firms? Is it going to be loan demand, or is it going to be a lack of competitiveness at a time when the big banks still have much more capital and much cheaper capital at that?
It's all of the above. And remember, the long-term structural challenges they face. We have the Basel III endgame kind of release coming out next week on what that looks like. And banks like PNC all of a sudden become more under the surface when it comes to stricter regulation. That's a cost. Ultimately, that's a cost.
Let's set up the next 60 minutes. The next 3 minutes, we get Bank of America in just a moment. Morgan Stanley a little bit later this morning. You're catching up with James Gorman at 1:30. We're all looking forward to that conversation. Let's start with B of A, which just drops right now. EPS at 88 cents. That's just come through. Net interest income, 14.29 billion. The estimate, 14.3 billion. Shonali's going to dig through this. We were talking about loans just a moment ago. 1.05 trillion, the estimate 1.05 trillion, that bang in line. For anyone who's interested in equity trading revenue, that comes in at 1.62 billion, the estimate 1.54 billion. Provision for credit losses in at $1.13 billion. Fixed trading revenue, 2.76 billion, the estimate 2.44. The stock is up in early trading by 1.6%. Shonali, you've had about 60 seconds, so go ahead.
Deep into it.
Well, there are a few things here that I want to cut right through. One is that their trading revenue is very impressive, right? I mean, they have a significant beat there, both on the equity side and a strong fixed income as well. We want to see those institutional businesses really be kind of the balance here for Bank of America when you start to think about other businesses. We also have provisions coming in line with expectations. Something Bank of America has not done yet is given those expectations for net interest income figures for the year, as we've seen the other banks not only do but raise. So it's not going to be an easy comparison to make when you think about what their full year expectation might be. They haven't given one yet. Interestingly, I think this is very, very important. The non-interest expenses came in above expectations. And so remember, Bank of America has long been an expense management story. Are investors going to be okay with that figure? I would also say they had a regulatory action that was recently announced as well. So
I'm afraid to ask, what's a regulatory action? Someone didn't do the dishes.
the CFPB, the OCC, they didn't like what was happening there. They accused Bank of America of some illegal practices when it came to overcharging on fees and when it came to handling certain customers.
Their PowerPoint deck of 37 pages is different than the JP Morgan Power deck of 39 pages. This has Moynihan acuity. What is Brian Moynihan's most important focus in this earnings report?
It's funny because, to your point, the charts are better, but I want that net interest income guidance. I want to know what they're making for the year. I think that there's kind of no other story in town when we were talking about the numbers that we were talking about earlier here. Can they meet the pace of JP Morgan's net interest income growth? It is very, very significant there when you look at that 25% increase in the first 6 months of the year. Can Bank of America keep up?
Is this telling that we're seeing Bank of America beat expectations, report very robust net interest income, basically loans in line with expectations, at the same time that PNC, the king of the regionals, reports the exact opposite? Is there a divergence that's really important to draw here between these two releases?
It certainly is. I mean, remember, this is the story of the season. To what extent is money moving away from the mid-size into the bigger ones? And even among the bigger ones, what kind of business are they taking on? We are still very much sitting in a story where JP Morgan, Morgan Stanley, Bank of America, Citigroup, not only big lending businesses, but massive wealth and investment management businesses. That means Silicon Valley Bank clients. That means First Republic clients. It is a war for those clients. And remember, JP Morgan just bought First Republic. They just hired a bunch of Silicon Valley bankers. So is Bank of America then still catching that share that's falling out of the market?
Let's plan out the rest of this morning. You need some more time to go through this release and we'll give it to you, but let's get to Morgan Stanley just briefly in the next hour, then a conversation with James Gorman later. What's the focus for you, Shonali, this morning?
I think, unfortunately, for Morgan Stanley, yes, it's about the numbers, but more it's about the succession plan. Remember, he said just a couple of months ago that he would be stepping down as CEO next year, but they don't have a new CEO yet named. So what is going to be the future of Morgan Stanley? By the way, we were talking about those Basel III requirements. They go right after Morgan Stanley, those fee-based businesses as well as the trading businesses that have had the benefit of lighter regulation for the last 10 years.
James Gorman, Morgan Stanley, in conversation with Shonali Basso, 1:30 Eastern Time. Don't miss that. In the next hour, earnings from Morgan Stanley just around the corner. B of A just moments ago, the CEO of that shop, Brian Moynihan of Bank of America, saying this just moments ago in the release. A healthy U.S. economy growing at a slower pace. We've heard a lot of that in the last week from the banks on Wall Street. The U.S. has a resilient job market. This from the CFO, Tom. The U.S. consumer health has remained strong. Heard that from Jane Fraser as well, TK, over at Citi.
Really can't say enough about the layout of the PowerPoint of Bank of America. It is a template for big and small banks out there across America. Christopher Marinac knows this. He's Director of Research at Janney Montgomery Scott. And the big advantage of talking to Mr. Marinac is he looks at the big, the little, and the medium banks as well. Christopher, I just want to sit on the big banks right now. I noticed the fancy deposit charts, and they don't run into log where I can look at the slope and all that. But as a generalization, looking back at Friday and looking now at Bank of America, are the big banks winning because they're simply siphoning money from the smaller banks?
Well, Tom, I think the banks are paying up everywhere for deposits, so they are winning, and we've seen a stability in deposits system-wide. So it is true that it's happening at Bank of America and the other large banks, including PNC this morning, too. I think everyone is paying much more. There's a catch-up effect where we are retracing back to the Fed funds rate, but there still is a big advantage for banks. I mean, there's a huge difference between where banks are paying for deposits and borrowings and what the Fed funds rate is and where it's going. So that advantage is still intact. You're just giving some of it back because every bank has to pay up for funds. That was a lesson learned from the March chaos.
Just to build on what Tom was saying, are we basically seeing that the big banks' win is the smaller banks' loss? Are we seeing that consistently as these earnings grind out?
I don't think so. I actually think the small banks had better loan growth, Lisa, and the second quarter data from the Fed. You know, if you look at through the end of June, the small banks actually grew faster, and the banks were flat on the large side. Deposits, I think, are about the same. We really haven't seen a big dichotomy between large and small. I think every institution across all asset sizes are paying up for funds, and so that is being translated into much more stable deposits.
We just are hearing from CEO Brian Moynihan that we delivered one of the strongest quarters in first half net income periods in the company's history, similar to what we saw with record net interest from some of the other biggest banks, including JP Morgan. Do you expect this to continue? Is this something that can be persistent, or is it a legacy of them not increasing the interest rates as quickly on deposits as they have reaped the benefits from certain loans they've underwritten?
I think it has a lot to do with credit quality still being very good. You know, banks are not writing a whole lot off. They are building reserves in general. You're seeing reserve building in today's releases as well. I think in general, these companies are healthy and resilient. And while you're correct that the banks had lagged on paying deposits, that's no longer the case. That is very much changing this quarter. I think will change again in Q3. The lack of credit problems is the signature notice for the investors looking at the bank sector, in my opinion.
As you know, folks, I talk about how the big banks are hiding their success. John Farrow, and I give Moynihan and his team massive credit for the clarity here. Page 13 and 14 of this PowerPoint is a deposit clinic. I'm going to have to take the rest of the morning, avoid the surveillance nap to read every word of it. John, consumer deposits from before the pandemic are up 40%. These banks are struggling. It's a chore.
Is it difficult this morning, Tom?
It's difficult. Up 40% in what, 3 years, 1 quarter, 2.5 years? Who's keeping
Usually gets
score?
harder the closer you get to annual compensation, TK. When you've got to pay out bonuses, things get really hard.
Major credit for Bank of America for at least stating it in King's English.
True.
King, it's a British phrase.
Okay, thank you for that, Tom. It used to be Queen's, didn't it?
Yes.
Then it changed in the last year. Do you want to tell us why?
No.
No, okay.
Too much on that. I'm reading about deposits.
I want to get to a basic question, and Lisa alluded to it. Higher rates have helped these banks. Are higher rates starting to hurt some of them in any way, shape, or form?
I think you're going to see net interest margins compress, John, for the rest of the month. There clearly is a pain from margins compressing. There is also a catch-up going on in loan yields. I think loan yields are going to continue to trace higher. Credit is scarce around the country, and so as credit is scarce, banks can charge more for new loans. And I think you're going to see that a lot in the second half of this year. That actually bodes well for margins stabilizing by year end. But in the meantime, because banks have to pay more for deposits to have those deposits be stable and grow, there is some compression there. But there's an offset on the credit piece, as I mentioned, and I think expenses are behaving pretty well also.
Chris, can we build on just consumer credit? We hear from every single CEO on Wall Street and beyond that this consumer is strong, that growth is okay, but it's slowing. And then we had this Fed survey come out in the last day or so, published every 4 months, and they showed the rejection rate for loan applicants has jumped to 21.8% in the 12 months through June. They indicated that was the highest level in 5 years. They also added this one. The overall credit applications declined to the lowest level since October 2020. Chris, I wasn't sure how to read that. I'm just wondering how someone like you might read into that, given your coverage of these banks.
Well, I think that we have a society in a country that has a lot of haves and a lot of have-nots, and I think there are absolutely cohorts of households that are struggling, and I think we can't ignore that. I think that while credit is scarce, it is available in certain areas, but in others it's not, and I think that's part of what the Fed is trying to do to try to expand that. But it's a real task. It's a grind, and I think you can see in the applications and in this Fed survey that it is not where we need to be at this point. So no, I think you should take it seriously. I know I do, and it's something we have to continue to work on. And I think there's pressure for these bigger companies, particularly like a Bank of America reporting today, to do more in the consumer field.
Just to sort of bring it back to the overarching theme, if there is a constrained volume of loans, then are there some banks that are winning at the behest of others? In other words, are we seeing the gains at Bank of America, JP Morgan, even Citigroup at the behest of European banks, as well as regionals, perhaps in the margins, perhaps it's overstated?
Well, I think if you think about it as a foreign versus domestic, I think there absolutely is winning on the U.S. turf, that we're doing better there. I'm not sure it's as much a size difference between large and small as it is domestic versus international. I think that's a great point to make, Lisa. I think that there has been a bigger retrenchment outside of the United States. And so I think that is partly reflected in today's earnings and what we will continue to see the rest of this week.
Hey, Chris, wonderful to get your input. Just phenomenal, not just today, but over the last several months, particularly on the regionals as we worked through in that mess a couple of months ago. Chris Marinac there of Jenny Montgomery Scott, back with us at 7:30 Eastern time for the Morgan Stanley results in about 35 minutes time. Back with us too, Sonali Basak right now. Sonali, we've given you an extra 5 minutes, so tell us, what have you learned in this release?
Well, a few things. To the point that we're making about the institutional businesses, Bank of America is firing on all cylinders. They're having the best kind of half year that they've had in trading in a decade or so. And if you take a look at it, what's fascinating also is that they're also currently, if you look at the mergers and acquisitions league tables on the Bloomberg league table data, Bank of America is number 3. Usually that spot is reserved for Morgan Stanley. So you are seeing them actually finding the investment in talent paying off. Why is that important? Because this expense number is higher than expected. And when you take a look at why, it's compensation and benefits being a part of that number. So then you have to wonder, is activity still robust enough to keep all those people on board, to the point Tom has been making? Bank of America has been doing drips of job cuts. They haven't made that surgical large cut we've seen at Goldman Sachs. But if you're making money, it pays to keep some of these people on board.
You think that's where the questions will be on the call in the next hour?
Yeah.
The media call, the analyst call?
I think for every bank, the expense question is a big deal. The other interesting comparative figure here is they only really bought in $2 billion more of net interest income than you saw a year ago. That comparable number at JP Morgan over that same period is $6 billion. So, we're, a billion here, a billion there. But still, it's a big deal when you're talking about where activity's going.
Sonali, stay close. Morgan Stanley still to come, 7:30 Eastern time, so 34 minutes from now. Then we'll catch up with James Gorman, the CEO, the chairman of Morgan Stanley, in conversation with Sonali Basak at about 1:30 Eastern time. Don't miss that. And tomorrow, we wrap it all up tomorrow with Goldman Sachs. On the market, Amy Wu-Silverman of RBC Capital Markets joining us in just a couple of minutes' time with your equity market down by 0.06% on the S&P 500 and yields heading south. We're down another 4 basis points. Your 10-year, 3.76.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In the eyes of investors, you have a lot of confidence that we've slayed the inflation boogeyman.
I think people have been too negative all year about U.S. economic growth.
The retail trade is still on in full force.
The Fed is going to be able to pause, and it's going to be a function of this inflation data coming down.
What markets are looking to now is what's going to happen in 2024, and it's not going to be 2023 where we see revenue growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market just negative on the S&P 500. Earnings season in full swing. In the last hour, numbers from Bank of America. In the next hour, we'll hear from Morgan Stanley and push through to tomorrow as we wrap up earnings on Wall Street with Goldman Sachs. TK BofA just 10 minutes ago. Expenses for Shanali Basak and the team. Very much a focus this morning.
Yeah, the expenses are going to be there on the right sizing for it based on the view from 60,000 feet. I'm going to look from the view from Moynihan, which is, he's sitting at Fenway Park looking out at the team come back out of last place. I might point out the Yankees in last place.
Had to squeeze that in.
Yeah, to get that in there. Thank you. But Bank of America, buried in the PowerPoint, John, is a minutia that Moynihan lives on. Equity business. The doom and the gloom, specs are over, things are terrible, we're not going to be able to buy the third home in the Hamptons. You know what, it was down 2%. Teensweens pullback there, and a VAR that was unimaginably small based on my amateur take. And the bottom line here is this is why scale matters. This is why big, what I talked about, the great hijacking that McDonald was talking about 30 days ago, Bank of America is part of that great hijacking. This looks to me like a really big, well-tuned machine, given all the challenges.
Lisa, Bank of America in the pre-market right now positive by a little less than 1%.
That's after delivering a 19% gain in revenue versus the year earlier. Just to put this into perspective, it is a game about net interest income, and you asked a great question in the last hour, John, which is, when does that end? Do we see a sort of end of the tunnel for this incredible boon that we've seen at JP Morgan and now Bank of America, as they haven't had to pass along some of that interest to depositors as much as they've been able to reap it from consumer loans that keep performing? A lot of questions with consumer lending very much in focus.
A beat on trading revenue as well. Shonali Baxter is going to be back with us in the next 20 minutes or so. We're going to break down the Bank of America numbers for you and get our teeth into Morgan Stanley when those numbers drop. The equity market this morning shaping up as follows on the S&P 500. Equity futures are just slightly negative. We're down by 0.03%. There's a bid into the bond market. Yields are lower by 4 basis points at 376. We won't spend a lot of time on this, but the ECB, one hawkish official, so-called hawk anyway, just being very non-committal around what they should do after July. So is it a July one and done from the ECB, like it may well be for the Federal Reserve? I know a lot of you have got that call in mind. So the bond market is bid, treasuries are rallying, but still the euro is stronger. I've said that, Lisa, for 9 consecutive days. 112.55 on a euro.
Which is kind of amazing if people justified the euro strength with a much more hawkish ECB. At this point, is everyone betting on a soft landing? Today, we do get more bank earnings. Morgan Stanley, as we've been saying, at 7:30 a.m. This follows what we got from Bank of America, which was a beat. We are seeing the shares pair some of the gains they initially saw, up 0.7%. Morgan Stanley shares up about 1% before that earnings. We're also going to be getting Western Alliance after the bell, after we did get PNC. The regional banks very much in focus to see if this dichotomy widens between the big and the small. Today, G20 finance ministers and central bank governors are continuing their talks in India. Curious to see whether other central bankers make similar types of noise, is what we heard earlier today from the ECB. Everyone is seeing a soft landing, it seems. And at 8:30 a.m., the latest read on the consumer at a time when we have had more stability in gasoline prices. You could strip out some of the volatility there and get a sense of whether people are spending less on discretionary items. This is one of the key questions, John, underpinning retail sales at a time when every single executive says that the consumers are still spending, albeit maybe at a slower pace.
So far, it's just the recession that never was. Citi and Andrew Hollenhorst publishing just moments ago. It was great to catch up with Veronica Clark in the last hour. A recession in theory, Tom, not in practice.
I really take issue with this after seeing JP Morgan. I'm fascinated to see what Fortress Gorman does. We're going to have a national slowdown of some form of sort of recession, actual NBER, whatever the jargon, the words you want to do. These banks are prospering off a financially successful America. I get the political thing. I get that half the America's flat on their back. I've never seen those numbers, and to be fair, they go back and do a pre-pandemic analysis. They're booming, period.
Morgan Stanley, 25 minutes away. Joining us now, Amy Wu-Silverman, the head of derivative strategy over at RBC Capital Markets. Amy, wonderful to have you with us on the program. We've had the bank earnings over the last week. The banks have lagged what's happened with tech. Pretty much everything has. Tech has absolutely dominated year to date. Amy, I'm sure you feel the same question that we ask repeatedly over the last several months. Can this rally broaden out? Do you think it can?
I do, John. And I actually think you are seeing that already in the options market. You know, we kind of take that metric of call exuberance. You know, where are folks buying single stock call options? And of course, that was in your NVIDIAs and your Apples and your Googles, not too surprisingly, a couple weeks ago. But we've really seen that expanded not only to S&P, but also to IWM names and also to smaller and mid-cap names. And that's kind of happening on a much broader basis than it was before.
Amy, let's cut to the wheelhouse. It's what everybody on Global Wall Street wants to know from Amy Wu-Silverman. What are the cross moments saying right now, the forward dynamics of the option space, and critically, to get a little bit jargony here, what does skew do right now?
You know, Tom, it's doing a whole lot of nothing. And I always say memory is really short in the options market, and it's gotten even shorter. So the folks who have had on, you know, long put trades, hedging trades, they've been burned. The best strategy year to date, when you back test every option strategy, has been to be long the S&P 500. So no option strategy year to date has actually just beaten being long the S&P. And, you know, you've seen that kind of taken to heart in the VIX levels and the volatility suppression that we've seen.
Right now, you said that you do expect the rally to broaden out. What are you looking at specifically for the areas to benefit the most in this broadening at a time when some people still are expecting consumers to stop spending as much?
Yeah, interesting question, Lisa. And I think, you know, it goes back to all these rotation trades that I think investors had wanted to put on even, you know, 6 months ago, even after the October bottom, which is value versus growth, or, you know, finally small mid cap versus large cap cyclicals, those type of areas. You know, one thing I will say as a caveat is I've asked investors why it couldn't be the case that we could just simply have a parallel rally. You know, so mega cap tech doesn't necessarily get hurt, but we just simply broaden the rally because one is sort of a secular drive of AI and the other is more of an economic recovery story. And to be clear to my earlier point, you know, we're not seeing less bullish positioning in tech. It's simply that bullish positioning has widened out a bit.
This is the reason why some people are saying, okay, let's just hold on a second before everyone gets over their skis in the soft landing type of narrative. Because if you look at the data, more people are invested than have been in equities going back for quite a while. We see a much more overweight suddenly in market technicals. At what point does that become a concerning sign to you?
Yeah, I watch this too, because I do think, you know, part of the story from the beginning of the year, Lisa, was that there had to be this catch-up trade, right? Well, one of the reasons I think we thought that positioning would get even broader was there are just folks who at the index level had to catch up to the momentum you were seeing from 7 names contributing so much to return. Now, from a positioning perspective, we are in a much better shape. But the question is there even more to go? I think there is if the rally becomes broader. And the second thing is, you know, you get these kind of technical rebalances, the technical rebalance for the NASDAQ, for instance, which will give folks who really couldn't participate in that narrow breadth to have some excuse to continue to do that widening breadth.
Does diversification pay here, Amy, or is it better to place larger focused bets?
So, Tom, it's interesting because we always think about that from a correlation perspective, and correlation has been really, really low on a realized level and an implied level because it's been, you know, tech going this way and then everything else going the other way. The one thing I point to folks is, look, if we get more things widening out and that breadth going, you know, even larger, then maybe that picks up the correlation component of index volatility. So to your question, maybe the reason volatility goes up and we see a few points tick higher is actually because of that widening of breadth, which actually makes your correlation component what kicks the vol into higher gear.
Interesting. Amy, thank you. Amy, Will Silverman there of RBC Capital Markets on the potential for this market rally to broaden out and the potential for this so-called soft landing to materialize. We've had so much commentary in the last day on all of this. We mentioned Jan Hatzius and Goldman Sachs saying the recession odds have been cut over at Goldman from 25 to 20. There was just this idea from the likes of Goldman, from Morgan Stanley and Seth Carpenter, that maybe you don't need that recession to get inflation back down to some kind of acceptable level. And even to hear an equity market bear like Marko Kolanovic of JP Morgan in the investment bank say the downside surprise on CPI means a narrow path to a soft landing is now modestly wider. I think that's the closest, Bramo, we've come to any form of capitulation from the team over there.
Yes.
That's it. That's all you're going to get, but it's something, Lisa.
And we're going to cling on to that because as far as we're concerned, it's actually a pretty big capitulation. At this point, though, here's my fundamental question. If we are seeing disinflation, but people truly believe that the lag effects have not fully been felt yet from the higher rates that the Fed has put on, then does that mean that there will have to be softness that people aren't anticipating later on, especially based on people not looking for loans as much and getting rejected, as you pointed out, when they do?
Yeah, I know where the soft landing consensus hopes and dreams are right now, but if you go beyond that, the division around this story is pretty remarkable. Veronica Clark was on this program from Citi in the last hour talking up the potential for re-acceleration in inflation in early 24. Torsten Slock of Apollo was on this program in the last week talking up the lagged effects of tighter monetary policy that's going to bite in the next 12 months. Now, TK, that's a big range of views out there. I'll touch base with Jim Bianco of Bianco Research in several hours a little bit later this morning. And this is your phrasing. He thinks the disinflation is transitory. Never mind the inflation.
But do the companies like Bank of America or frankly Western Alliance at 4 p.m. this afternoon, see Romaine Bostic for that. John, let me cut to the chase. Do they do any poorer with that inflation outcome? I'm not sure. I mean, they're adapting and adjusting, and they're minting money.
That's what companies do, Tom.
That's what
they adapt and, you know, what was it? They adjust.
They adjust.
That's right.
Can we adapt right now?
You did that good.
Joel Levington is the smartest guy in the block. I mean,
That's true.
He's a Bloomberg Intelligence, and he does credit. He has just published, John, that 296 GTB Ferrari you want.
Yes.
You know, go down Madison Avenue looking, you know, for what you can. I mean, you know, it's popping in. The EBITDA on that Ferrari is $175,000 profit. That's what Ford pickup trucks having trouble with. the margin on it is $175,000.
That's called a luxury margin.
That's a luxury margin. Joel Levington to the rescue today.
Have you been past the showroom on Park Avenue?
I have. I've never been in. I know you've been in.
I haven't been in. I'd just like to have a look.
I agree totally.
I just love to.
Why don't the others more do it? That's what I don't understand.
I don't know. It's just so beautiful. You know, is there anything more aspirational than that? It's just. You know,
I think the green team. The green team
beautiful.
is trying.
Oh, no.
They're trying. Aston Martin. They're doing the same thing.
Yeah, I noticed.
They're showrooming
that too. Okay, from New York, welcome to the program. If you're just tuning in, equity futures right now on the S&P negative by 0.05%. Coming up a little bit later this morning, in about 17 minutes' time, we'll pick up the coverage around the bank earnings again. Morgan Stanley results just around the corner. Tom, and then it's on to James Gorman, a man we all respect, hold in high regard.
Looking at wealth management, Bank of America, the stunning and Republican-influenced J.P. Morgan Wealth Management. First thing I'm going to turn to with James Gorman is what he built doing, and that is with E-Trade, Eaton Vance, and the rest of it coming in. What is Morgan Stanley Wealth Management doing?
Who comes next? Got to work that out with Shnali Basak too. As James Gorman
small
heads to the
matter.
exit.
You think bombshell announcement today? I don't know.
I don't think so.
Lisa
what would I
Shallot?
know?
I mean,
Bramo's got the
Lisa
inside.
Shallot would run it with an iron fist.
Is he going to do the Bob Iger? Found a successor.
It's me.
He's got two thumbs and is right here.
It's me. It's going to take a little bit longer to find one, like another 2 years. I mean, come on.
Yeah.
From New York, this is Bloomberg.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Earning earnings season is here.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
You're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We are looking carefully at outbound investment controls to make sure that we've covered all the channels by which technologies can be transferred to China that we think pose national security concerns. If we go forward with these, they would indeed be narrowly targeted.
This is a really important conversation. The US Treasury Secretary Janet Yellen with Bloomberg's Anne-Marie Jourdain. The two words that matter there, narrow and targeted. The team here at Bloomberg learning this morning that the US is planning a narrow limit on China investment, outbound restrictions. The story reads as follows. I'll share the lead paragraph with you. The Biden administration plans to restrict investments in China, and they will be narrowly focused on cutting-edge technology. Only new investments, TK, and they won't bite until 2024. So for the hawks down in D.C., this is important. It's going to be narrower, potentially, than anticipated, and it's not going to come quickly enough for a lot of people either.
You know, it's gallium and germanium, and we make fun about it, and we all flunked this in chemistry class. Anne-Marie Jourdain killed this in chemistry, by the way. But the answer is we make jokes about it, but it's really, really serious. And they're looking at a bipartisan focus on batteries. And there was a chart in The Economist this weekend that showed the climate change differential and the build-out necessary for batteries to make all this EV stuff go is... ginormous is the only mathematical word I can come up with. It's huge, and that's what they're focused on.
And is it achievable not working together? Can you hit some of those targets?
I don't know, but
there's some common ground between these countries, Tom.
There's common ground there about the technology to come, but the debate to me is a political debate. Anne-Marie Jourdain, off of her Yellen interview yesterday, can assess the politics here in Washington. Anne-Marie Jourdain simply, can everybody get behind what the Secretary of Treasury is proposing, which is a narrow China proposal?
Well, it's an interesting line for the administration to walk because this will anger some of the hawks in Washington, D.C., which wants to see a more broad outbound investment executive order. They want to see a larger scope and size, not something so narrow, not something so direct when it comes to the outbound investment. Basically, it's going to be reverse of CFIUS that will track this going over to Beijing. At the same time, it comes to the administration is trying to put a floor on relationships. Right. And that is why in the Treasury Secretary's most recent visit, her visit to Beijing, she outlined what this outbound investment would be, because we already know that this has angered Chinese authorities. They say this is the U.S. trying to isolate their economy and go after their economic development. And that is part of the reason why she also went. So they are trying to make sure they can keep relations stable, but at the same time ramp up some of their concerns when it comes to national security.
Anne-Marie, cut to the chase. How will China retaliate if we go after, say, rare mineral battery technology?
Well, I think we need to see what ends up coming out in the executive order. It keeps slipping. Jake Sullivan called for this more than 2 years ago. My reporting more recently was that it's supposed to be done by the end of July. Our colleagues are reporting now, end of August, and then it goes into a hearing review with the public. So we're not going to actually see it take effect until next year, and then that would likely be the time we would see a response from Beijing. But if it's very narrow in scope, potentially there isn't a response.
How does the China discussion play into 2024, which may be when these sanctions take effect, but it also is the election, and it becomes a very political moment where Biden is looking to really hold on to his seat with pretty razor-thin margins?
Well, the rhetoric is just going to get hotter and hotter every single day when it comes to Beijing. Every candidate is going to be asked how they feel about relationship with China, what they would do in terms of whether it's Taiwan, whether or not it's human rights concerns coming out of Beijing, whether or not it's Xi Jinping still backing President Putin, not condemning the war in Ukraine. every candidate is going to be asked about this, and the rhetoric will be obviously very hot. It is advantageous to run a political campaign to say you are a China hawk. That polls very well. So that is what is going to happen as we go into 2024. So for this administration that wants to make sure they also have a dialogue with China, it's going to be a hard needle to thread.
Talking about the election, the former President Trump ostensibly is putting together a plan to overhaul the executive branch, this according to the New York Times. Our current executive branch, this according to the architect of this new plan, was conceived of by liberals for the purposes of promulgating liberal policies. There is no way to make the existing structure function in a conservative manner, talking about eliminating the deep state. Does this fly? Is this a popular approach with others in the Republican Party?
This sounds like this is a very Trump populist approach for him and his base, the 30% stronghold that he has. The issues that the others in the party face is that they are trying to not just knock away some of that 30% hold he has, but also gain a larger majority than him. And what many are concerned about in the Republican Party that do not want to see a Trump 2024 nominee is the fact that we could see what we had in 2016, which just comes down to a plurality. No one gets the major popularity, but he will still maintain that 30%. Everyone else just divides it. But this sounds like something that is very Trumpian, less so what we'd see potentially from other candidates.
I look, Anne-Marie Horton, at the calendar for July, and we're sort of into the summer doldrums right now, and it just gets completely upset by Republican politics, as Lisa mentions as well. I am thunderstruck over the raising of money. I know you're really ready on this. Give us your treatment across, 18 candidates? What's the biggest surprise for you in the inability or ability to raise money for the GOP?
I think the biggest shock had to be the money that Mike Pence brought in the second quarter, $1.2 million. We're seeing members of Congress bring in more money than him. This is a former vice president, that makes questions on whether or not he even meets the threshold to go on the debate in Milwaukee at the end of August. But that, for me, was very shocking that this is a former vice president and the money he brought in was so low. I think another big shocker on the other side of the aisle is, of course, Biden brought in $72 million in the second quarter. The campaign says they have $77 million cash on hand. So that speaks a lot of optimism from his backers about the former president, the current president, even though poll after poll continues to show that many in the electorate are concerned about Biden's age.
First debate, a month away for the Republicans. It's amazing. It's just around the corner.
Yeah.
Anne-Marie, we've had a conversation about whether or not the former president would show up to that first debate. Any read on that right now?
Not at the moment. I think he says he's not sure yet, or he says he won't. I think for Trump, he just views it as almost pointless. He has the 30% hold he needs. Why would he show up when he's probably going to be attacked by everyone? But at the same time, others say he loves his show. So if he's not part of it, that potentially won't bode well for him. Maybe he does counter programming. Remains to be seen, but a lot of individuals like Chris Christie are really trying to troll him to show up on that debate stage.
Oh, big time. Christie's out for him in a big way. Anne-Marie, thank you. AMH down in Washington, D.C. Put that one on the calendar. August 23rd in Milwaukee, the first GOP primary debate hosted by Fox News. TK, that's one to watch. That's a big field that needs to narrow down fast.
Early and often, I think that's a key word, is you got to narrow it down. And what's interesting to me is the little micro battles I see. I've been focusing on Iowa, but, to be direct about it, the conservative and evangelical heart of Donald Trump's GOP party has a voice, and they're letting it be heard on the road to August.
Coming up shortly, we're going to change focus away from politics and get back to the banks. Bank of America reporting a little bit earlier this morning. Morgan Stanley coming up very shortly. Those numbers should drop in around about 5 minutes' time. Chris Marinac of Janney Montgomery Scott reacting to those numbers in just a moment. And Bloomberg Sonali Basak back with us in the studio to break down the results from James Gorman's team and look ahead to a conversation with the CEO and chairman of Morgan Stanley, James Gorman, and Sonali Basak, 1:30 Eastern Time from New York. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Earnings from Morgan Stanley are seconds away. Going into it, equity futures on the S&P 500 negative by 0.04% on the S&P 500. On the Nasdaq, we are down by 0.12%. Just a little softer, but absolutely no drama whatsoever in the equity market this morning. In the bond market, there is a rally. It resumes. Treasuries firmer, yields lower by 4 or 5 basis points on a 10-year, 375.79. Looking at a 2-year right now, down about 4 basis points on a 2-year. Just a little north of 469 on a 2-year, down 4 basis points. Numbers from Morgan Stanley. Just dropping. I'll allow Shanali to get through that and just finish up with the euro just quickly. The euro advancing for a 9th consecutive session. We are stronger on the euro against the US dollar for the longest streak going back to 2004. Here are some numbers for you from Morgan Stanley. Second quarter wealth management net revenue, $6.66 billion. The estimate, $6.5 billion US dollars. There's a lot in here. Shanali's had a couple of seconds to break it down. Shanali, just give me your first look, and then we'll give you some more time to get through it.
Morgan Stanley back on top, beating on equity, sales and trading revenue. We know Morgan Stanley is the kingmaker in that room. Fixed income sales and trading, however, slightly shy of expectation. That's a bit of a business that they're trying to grow and compete on at a greater scale. They're kind of the baby of the group there when you compare them to JP Morgan and Goldman Sachs. Now, wealth management revenue coming in above expectations, and James Gorman in his statement really highlighting here that $100 billion in wealth and investment management net new assets, bringing in over $200 billion year to date. That is a number that he wants to bring in more than $1 trillion every 3 years, and so he is showing you that they are well on track. And also the story we've been talking about all morning here is how much more business can they squeeze out as some of these other banks have shed the market.
I want to go to more on compare. We're not comparing Morgan Stanley to JP Morgan, right? We're comparing them to Goldman Sachs.
I think they deserve the JP Morgan comparison when they're both trading at almost 1.6 times book value.
Fair.
So you're getting Morgan Stanley here with a lower ROE for the quarter, but the similar
I
book
get that,
value
but I'm
trading.
looking at a pre-tax margin on what matters, wealth management for Morgan Stanley rather. They're going to go to the decimal point here. 25.2 is different than 25%.
But 25.2 is actually less than expected. And so, at the same time, they have cost to contend with just like anybody else.
How does did she pull an all-nighter before this?
Quick question, Shanali. I'm looking right now at net interest income, which actually came in below expectations, coming in at around $2 billion versus the estimate of $2.3 billion. How concerning is that at a time when the likes of JP Morgan and Bank of America meaningfully beat?
Yeah, and I think that is very important. It's to the point we're all talking about here. When we look at the numbers, we know that the market is quite soft across the board. And to Brian Moynihan's point, slowing. And so the competitive pressures here are stark. And these businesses are being competitive on every business line, including the bottom line, including costs. And so one thing that's interesting here is you have Morgan Stanley already highlighting, for example, severance costs. And that is a spare cost that everyone has to contend with. in terms of compensation costs. The unfortunate thing about severance costs is that these are not costs that are necessarily adding to that top line for that competitive pressure we've been talking about.
Stock is up this morning in the pre-market. You mentioned Brian Moynihan. Let's talk about the arc of the quarter, according to James Gorman of Morgan Stanley. The quarter started with uncertainties and subdued client activity. The quarter ended with a more constructive tone. What do you make of that?
You know, we've been talking about this, the disparity between the types of clients you have. For Morgan Stanley, you are banking the creme de la creme, and it is across America, which is kind of a less choppy market than you see in a lot of parts of the globe. That wealth management pre-tax margin, the reason that they missed is because of those expenses we're talking about. Now, they do have record net revenues in that business, and so the multiple you're getting at Morgan Stanley is really driven by that booming wealth business that is just raking in money.
I mean, I want to go to Goldman Sachs tomorrow as well. To be clear here, particularly for those that are not sophisticates like this on you, they don't have a Marcus, do they? I mean, they don't have a distraction.
They don't have a consumer business with such ugliness in it. They don't have such risky clients in that consumer business. As we've been saying, they bank the wealthier, and they do drive net interest income that way. Now, there's another thing Goldman Sachs has that Morgan Stanley doesn't have, and that is potentially $2 billion worth of write-downs tied to that consumer business, the Green Sky consumer lending business, and importantly, a commercial real estate portfolio that is baked into their asset and wealth manager here that they are trying to compete with Morgan Stanley on at scale.
Just quickly, early question for the man himself.
Succession. There's no other story for Morgan Stanley.
Even after that.
With these wealth management numbers, you have to ask, what does the board want of a new candidate here? Do they want an asset and wealth management head? It's the same reason Dan Simkowitz, Andy Saperstein are competing so heavily with Ted Pick, the institutional guy, you know, a year ago you would have said he had a shoe-in, and it was his to lose.
This is very funny. I would suggest that perhaps the board of Morgan Stanley, and I got a friend, Mike, that's, I think, pretty good about this. Probably what the board is going to say, can you find someone that won't screw it up?
Yes, given the trajectory they've been on
I'm just
under
borrowing
Gorman.
that from a guy, Mike, who
There are
happens to watch
headwinds
the
that
show.
they have that James Gorman won't have. They have more regulation in the businesses that made James Gorman a lot of money in the last 10 years. And so that means pressure on ROE no matter what.
Shanali, thank you. 1:30, don't miss it. Coming up a little bit later this afternoon, 1:30 Eastern Time. James Gorman, the Morgan Stanley Chairman, CEO, in conversation, Tom, with Shanali Bassek.
To provide context, Christopher Marinac, Jenny Montgomery Scott. Thank you, Christopher, taking time out from your clients this morning. Is Morgan Stanley a bank?
Absolutely, sure. They make loans and take deposits. Their deposit costs rose a lot in this quarter, Tom. I mean, they had 100% beta if you look at the change in average deposit costs from first quarter to second quarter. So that's 47 basis points, which is exactly what the average change in the Fed funds rate was for the quarter.
I am fascinated by the compare and contrast with the mystery of what we'll see tomorrow with Goldman Sachs. To begin that study, what's the key distinction here of a Marcus-like free Morgan Stanley?
Well, I think Morgan Stanley can get access to funds cheaper than what Marcus is paying. Marcus is the rate leader in the marketplace, and so that has a different spread component at the bank level, and I think that's awfully important. I think there's less of an advantage at Goldman on the cost of funds, and so that's one thing that most banks have, and certainly Morgan Stanley does have an advantage in terms of borrowing and raising money cheaper than the cost of Fed funds.
As we parse through the results, and Shanali was great about pointing this out, at Bank of America, the average FICO score was 767, an incredibly high, very well-off kind of customer base. We're seeing a similar type of suggestion in the numbers of Morgan Stanley. What does this mean for those who are not in the echelons of the upper tiers of income earners? Does this mean that they are not getting credit, or does that mean that they're going to the PNCs of the world, maybe the Western Alliances?
I think all those banks tend to have a higher FICO score in general. So I think, unfortunately, they're probably looking outside of the banking industry and other sources, which really means that it's more expensive. I think that's the hard part. The banks are bragging about having high FICO scores, and that kind of cuts both ways. It's good from a credit quality perspective, but it does make it difficult for certain borrowers to access funds from a consumer standpoint.
Right now, as you take a look at Morgan Stanley, Bank of America, JP Morgan, Citigroup, Wells Fargo, who looks the best to you in navigating a pretty uncertain time?
Well, Bank of America has the best deposit base in the country, and so that gives them a leg up. I mean, they have access to consumer funds that are cheap, and they have a big advantage over Fed funds, as I mentioned earlier. I feel that they've got a lot going for them. They also have been a leader on the digital build-out. JP Morgan has too, and those are two big engines of the whole transformation of the industry towards digital. That's going to continue to create a wider gulf between other banks in the quarters ahead.
Hey, Chris, in the zeitgeist of this July is a massive roll-up worldwide in asset management. Clearly active management, but dare I say also index passive management as well. Is Morgan Stanley one of the giant players that can take advantage of that roll-up, or do they have to grow and defend against the roll-up?
Oh, I think they're in growth mode. I think if you go back to March and April when we had the explosion of First Republic, they received several clients and teams of people, and I think that's going to bode them well. Even though they did not bid on the bank, they still had a lot of transactions and new customers that have come in, and I think that's going to become more apparent on the asset side in the months ahead.
Shonali Basak is studying the succession plans as well. You're a student of it. What kind of person should be taking over? A wealth manager, a banker, somebody from outside?
I think you need one who can be a leader. At the end of the day, you need a person where he or she can really focus on how to lead an organization, bring in new clients, being able to be flexible when you have market volatility like we've already seen this year. That's really is what it's about. I would be less about labels about whether they came from the investment side or the bank side. I think being able to lead a team of folks and grow the business in the next decade is what I think is most important.
Hey, Chris, appreciate you being with us this morning. Chris Marinac there of Jenny Montgomery Scott of Bank of America in the last hour and Morgan Stanley numbers as well. Goldman, the last big one still to come. They report tomorrow morning. TK, Goldman, the last big one, and the bar's set pretty low, let's put it that way, given some of the communication we've had.
Well, the communication, I've never seen the mystery in the press different. It's not just Bloomberg, it's others as well, just saying, okay, what are we going to see here? And the massaging, I should say, not managing, the massaging of the message is going to be fascinating tomorrow.
I'm also curious, before tomorrow, just some of the earnings calls that parse through some of the data that we got from Bank of America and Morgan Stanley. Just looking through the numbers, Morgan Stanley's second quarter compensation expenses were $6.3 billion. The estimate was less than $6 billion. We're going to be talking about efficiencies. Where do those cuts come into play? How significantly will they be affecting some of the populations? These are some of the questions that are ongoing at a time where people really are looking for places to trim around the board.
These moves fade in this morning. We're positive by 0.4% on B of A. Morgan Stanley up by 0.4%. Tom, not just about the major players, about the regionals as well. We've talked about this a few times. A few months ago, it was a completely different earnings season on Wall Street. Just totally different atmosphere around the financials compared to where we are now.
Yeah. And frankly, and I am as guilty of this as anyone, dare I say Western Alliance is of equal interest.
Sure.
Is Morgan Stanley this afternoon at 4 p.m. Here's the book value study. This is the acclaimed BQ screen in the terminal. It's one of the reasons people buy the terminal every day worldwide. It just gives you a snapshot of the ratios of a given company. Price to book, Morgan Stanley 1.57, Goldman Sachs 1.02. That is a wow differential.
There's a different set of pressures at the top of Goldman, would you say, Tom? Compared
massive.
to the top of Morgan Stanley, whoever takes that seat.
You know, I have to put the surveillance cork in my mouth. You know, Basic's like.
Have you ever found that cork?
Oh yeah, there's a supply down here.
Is there?
Yeah, but it never gets up to
never
the
comes
area.
Out. Talked about it a lot, never seen it.
Never seen it.
No, we did. There was a sighting once. I remember that clearly. The taste.
What year was that?
Oh no, it was recently.
It was recent. Okay.
Yeah, you know,
the 80s.
It was when.
Yeah. Just tuning in. Welcome to the program. Equity futures on the S&P, negative by 0.09%. Morgan Stanley out with results just moments ago. The stock is fading, Tom, in the pre-market. I'm looking at the pre-market right now. Morgan Stanley is positive by, let's call it 0.4. Bank of America up by 0.3. It's been a beat across the board, would you say, so far on Wall Street, TK, relative to expectations?
But there's a little bit of nuance, you know, in the typical things that Shonali follows. I'm not a student of them, but, you know, I'm not going to mince words, John. It's uneven, I would say. across the different companies.
Uneven, and yet we've seen some pretty dramatic numbers, or dramatic numbers, I should say, in terms of incredible revenues from net interest income that's gone up, and yet Morgan Stanley shares year to date 3.3%. JP Morgan shares today are the real outliers, up 17%. But, Bank of America shares down 9% year to date and not really climbing that much after better than expected earnings.
We'll get back to the market price action in just a moment. Greg Peters of PGIM Fixed Income will be joining us shortly in the next hour. Looking forward to catching up with Jay Bryson of Wells Fargo, Ed Morse of Citi as well. Ed's saying that the commodity bulls have got this wrong, that the crude oil bulls have got this wrong, and you should keep an eye on what's happening in China. Crude this morning, just to check out WTI and Brent on my screen at the moment. Crude south of 80 in the last 24 hours. To give you the quotes on Brent at the moment, 74.50 on WTI, on Brent, 78.80. On the fixed income market, with treasuries rallying and yields lower, Greg Peters of PGIM Fixed Income coming up shortly, a week and a day away from a Federal Reserve decision and potentially another rate hike from Chairman Powell and the FOMC.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Moment news breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Fixed income, this is a pretty good scenario. This is nirvana for a fixed income investor, where you can get sixes without taking a lot of interest rate, credit risk, beta risk. You can build a portfolio, hold some equities for some upside, and then build a lot of income in your portfolio. It's a pretty good environment for a fixed income investor.
Rick Reeder, CIO of Global Fixed Income of BlackRock, subscribing to the idea that maybe you get a soft landing, but ultimately sees a lot to like in fixed income at the moment. He found that way at the start of the year and still feels it this time of the year, at the middle of the year, in June, July, going deeper into July and seeing a bond market that is rallying. Yields are lower on a 10-year, on a 2-year this morning. Let's pull up the board and have a look at what's happening. On a 10-year Treasury, yields are lower by 4 basis points, 376.38. This dollar sell-off continues, but only just. The euro 112.43, Tom, this morning. Higher the session on the euro today, getting closer to 113. I can tell you your session high was 112.76. Not far off, yeah. It's quite a turnaround.
Because it's still a resilient euro, and you see it across other things. Forgetting about the idiosyncratic Turkish lira, which is going to print a 27 here any moment. That shows the chaos out there in Turkey and Argentina. I would point out to Rick Reeder, John, and I think this is really, really important. The sum total that I look at is the Bloomberg Total Return Index, either corporate, as we discussed yesterday, or total return aggregate. And the answer is it's an in-betweeny space. where price really hasn't come down, price really hasn't come up.
Have we seen the peak in yields? Maybe at the front end, given what we're hearing from central banks, not just the Fed in the last week, but also from the ECB. Those comments, Tom, haven't spent a lot of time on them, but to hear a hawk on the Governing Council say, yes, sure, July, let's go, but ultimately in August and beyond September, who knows what we do in September and beyond?
The manufacturing pulse of Germany here, we've got such an important guest now. I want to get through this quickly, but the read of the weekend was Christian Odendahl over in The Economist on the delusion of manufacturing, and that speaks right to Odendahl's Germany. I mean, it goes right to the
totally different growth profile in Germany compared to the US right now. Couldn't agree more. The China influence is huge compared to the United States.
Went back and forth with Mohammed Al-Arian on that yesterday. We'll keep that theme of manufacturing here through a hot summer. Gregory Peters is cool, calm, and collected, co-CIO at PGIM Fixed Income right now. Greg, if I define a given aggregate index as in between here, maybe on a technical basis, it's a pennant formation. Which way is price going to break? Are we going to get higher price, lower yield, or the other way around?
I think it's the other way around. If you look at what's going on in the market is very excited around policy rates peaking. But if you see what's embedded in the future price, there's talk about soft landing, inflation coming down, and then on top of it, you have pretty substantial rate cuts. So those two factors are somewhat confusing to me, right? If the economy continues to actually chug along here, we avoid a recession, I'm not necessarily sure why forward rates should be 200 basis points lower than they are today.
I look at where rates are and what is going to give way. From where you sit, how will issuance change given price down, yield up? What will be the spirit of the market?
Well, what we've found over the past, couple of years is that there's not a lot of price sensitivity here. Corporates will issue when they have to. There's a constant desire to issue. So I don't really worry about that factor too much, honestly. So, to me, I think it's steady as she goes. So I think it's a very good environment for fixed income, for sure. But at the same time, some of the pricing confuses me.
Okay, let's talk about that, Greg, particularly in investment grade. Why do you think that prices are just too high?
Well, it's not so much. Well, it's pricing in a soft landing, which I think should be the modal outcome. But the risks are still, pretty elevated. And so I look at, IG credit spreads, index level, just called 125 basis points. That's well below the long-term average, long-term mean. High yield is sub 400 basis points. So you're not getting paid a lot from a spread premium standpoint vis-a-vis the risk out there. But the overall yield environment is a fantastic one, and I think that will continue to drive flows into fixed income. It makes fixed income a very attractive place as we're back to the roll and carry days, which I think is the hallmark of fixed income investing.
Typically, after banks report earnings, they issue a slew of bonds. We saw Wells Fargo float an offering yesterday with an 8 handle, offering more than 8% yield. It was on a subordinate bond with equity-like features. Is this a type of asset that you want to own? Are you looking to the big banks and saying, I'm a buyer?
Yeah, so the key point there is equity-like features, right? So I've always been of the mind, we've always been of the mind that that's a poor risk. You have fixed income type of yield with, equity optionality, so the option is always against you. So never really liked that part of the market, known as the COCO part of the market. But the senior place looks very attractive to us and continues to be. So, the money center banks, as we call them, are very attractive investments in fixed income and continue to be one of our favorite places to play in investment-grade corporates.
The theme with price down, Greg Peters, is I'm going to get a coupon along the way. I get that rationalization. But as a general statement, out 1 year, or dare I say out of PGIM short-term 3 years, are you going to clip a coupon, or are you going to invest out 3 years for total return?
I still believe that given the shape of the curve, given the attractive nature of the front end, to me, it doesn't make a whole lot of sense to go out in duration. So I think front-end carry, just called 3 years in, Tom, a very attractive place to play. So I don't really see the need to kind of reach, right? I think investors are still very much in the reach for yield environment, going back pre-pandemic. And the truth of the matter is you don't need to reach now, right? It's right in front of you. So there's no reason to take, unnecessary amount of credit risk or duration risk at this point in time.
Does this mean that you don't necessarily buy into the soft landing narrative, or just that it doesn't matter whether there's a soft landing or a hard landing, you're going for the sure thing?
Well, so I mean, you go to the soft landing narrative. So I don't understand, this is the price confusion in my mind. I don't understand, if you believe in a soft landing, why the Fed would be cutting 200 basis points at the same time over the next, year or so. So to me, that's the incongruency in the market. So if you actually do get a soft landing, right, I think front-end yield will remain pretty sticky. So maybe there's a little cuts, into the market, but that should help normalize the curve, which means, the inversion starts to normalize, and that means kind of higher yields across the curve. So that's how I see it, actually.
Greg, one of the best. Always a privilege to listen to you. Greg Peters there of PGIM Fixed Income. Thank you, Greg. Mohammed Al-Arian said on Friday, this market has rallied this year on things that haven't happened, not on things that have. Just think about that, this earnings season. We came in and we were worried about things like credit quality, and there's just been nothing scary so far, Tom, in earnings season so far.
It's the ex-ante bet in an ex-post world, and particularly as for central banks, they look after the fact, and what Dr. Al-Arian is suggesting is the market's always out expecting. I like to say on the equal sign, there's expectation on both sides.
It's also the delay in some of the read-through effects of monetary policy. And I keep thinking back to that Fed survey that you mentioned, John. This little nugget, the rejection rate for auto loans exceeded the application rate. This was for the first time ever since the survey's inception in 2013, just to give you a sense of the changing credit dynamic that's happening in real time.
It's just amazing, the pushback you're starting to see, Tom. There are people struggling. You talk about it a million times. TK, a lot of America flat on its back, struggling to obtain credit. And then we went through B of A, and the average credit score of their customers is in the high 700s. For anyone that tracks their credit score, anything north of 700 is pretty tidy. High 700s, it's pretty decent stuff, Tom. That means you've got a pretty solid consumer at your company as your customer. I'm not sure that's an accurate description of everyone in this country right now.
In the Goldman Sachs tomorrow, and frankly, all of earnings season, and I look forward to what we're going to see through technology at least. And everyone's rationalizing. And as I said before, it's Rationalization Tuesday. And let's go to someone you follow more than me, John Kalanovic at JP Morgan, where he's talking about it's modestly wider. The chances of getting to a soft landing, it's modestly wider. I think there's an adverb in there somewhere.
It's about as fast as he would go, that the path is still narrow, but it's modestly wider after the data of the last week.
The Red Sox are out of last place, so we're rationalizing.
Where are the Yankees?
The Yankees, I believe, are in the, when I filmed at Fenway, the Yankees were in last place. They've returned. They've returned.
Is that because of the release of your special coverage of the Red Sox?
Get a shortstop.
Sure.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career, given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
We do see a recession still in the horizon.
We're looking at rates that are 5+%.
We see that it is possible for us to get to a 2 to 2.5% inflation rate in 2024.
We've seen consumer spending slow. We've seen business investment slow. What we haven't seen is the type of retrenchment that we typically see ahead of a recession.
I think the economy is going to surprise people by its resilience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television across America, worldwide. An extraordinary rationalization Tuesday in the middle of bank earnings, on to Goldman Sachs tomorrow. But far more than that, John, on to the mystery of the rest of American earnings.
I like to go to the 12-month forecast of 12 months ago, Tom. It's where people thought we would be, and we're nowhere close.
Nowhere near it.
We were talking about unemployment going to 4, 5, maybe even higher, 6%. We're still at 3.5%, even with the Fed going from 0 to 550 and maybe even beyond. And TK, with the earnings today, to build on what Mohamed El-Erian was talking about on Friday, it's not about what has happened, it's about what hasn't happened. With the bank earnings 3 months after a crisis for the regional banks, it's just not terrible. And not terrible is so much better than what was expected 3 months back, never mind 12.
I'm going to take it even further and go not only the crisis of the banks a number of months ago, but we're still within the shadow of the pandemic, the dynamics of a consumer. Here's Moynihan talking, I believe it was Moynihan, maybe the CFO, talking about a buoyant American consumer. That's French to a lot of Americans. They don't buy it.
And this is the struggle reading this economy right now. Huge demand pull forward for goods in a pandemic. Push it out for services. Here we are experiencing the pent-up demand for services, travel, cruise lines, airlines, all of that. And then you look at manufacturing sub 50 in contraction, recession, China not doing great, Europe in recession, Germany specifically. And then you look at services still really robust. And at least for myself, I've been asking this question of guests over the last few weeks. How do you think that converges? Manufacturing up to services or services down to manufacturing? And that's still a debate right now, halfway through 2023.
So we all agree we don't have a clue out 12 months where we are,
No clue.
like we got wrong 12 months and 24 months ago. Lisa, what's your take on this? What's the development through the summer that you were looking for?
Actually, the tightening in credit. I think that Fed survey is really interesting. On the margins, how difficult is it for people to get loans? How much higher do credit card interest rates go up as some of these banks
mentioned autos. They're saying no?
Yeah, there are more people getting answers of no than yes to their applications for auto loans at a time when there are a lot of people who are underwater, who took out loans for cars that were worth substantially more than they are now at a time when you've got the likes of Ford cutting prices.
And John, let me go to you here. Well, we saw the huge F-150 cut yesterday. Ferrari, John, I don't believe they're cutting even on that.
No, I don't think they're cutting prices over at Ferrari.
Not as well, but this goes to the heart of what we've heard from, it was Veronica Citigroup. Help me.
Veronica Clark.
Veronica Clark,
Yeah.
thank you. Andrew
Hollenhorst.
Got it. Nailed
keep
that.
doing this.
They were a good duo. They play Crosby, Stills, Nash like no one. But the answer is Veronica nailed this, and like everyone's waiting for the job market to break. There's no evidence of it.
Veronica's pushing another story too, and it's the reacceleration of inflation in early 24. You can find consensus on Wall Street right now about a soft patch for inflation, disinflation through the summer. The division starts to emerge as you get beyond August and into September and into the fourth quarter after that. And there's a view at Citi that things reaccelerate and pick up again. I mentioned Jim Bianco earlier on today. We've all caught up with him recently. I'll catch up with Jim in a couple of hours' time. Jim believes that disinflation will be transitory. That inflation hasn't topped, it's bottoming. Get your head around that. He thinks that inflation is bottoming for 2023. That's a very different perspective to the popular narrative on Wall Street over the last week.
FHN Financial with a nice pulse on the street. Lisa, to quote exactly moments ago, with the Atlanta Fed's GDP tracking model estimating 2.3% annualized growth, even a big downside miss on this morning's retail sales will be a decent second quarter. That captures it nicely.
This idea of immaculate disinflation, once again, very much in vogue at a time when there still are people saying that the Fed's tightening will have ramifications and that you cannot have your cake and eat it too. This has been one of the big disagreements. If you do get inflation coming under control, can it be painless, Tom?
10-year real yield, it pulls back the disinflation in place off that key statistic, 1.5026. John, a 1.49% 10-year real yields. Jermaine, we're not there yet.
Nominal yield down 5 or 6 basis points if we can get up the board. The bond market looks like this, 3.75 on a 10-year at the moment. The 2-year down 5 or 6 basis points to 4.69. We've been drowning in bank earnings. Don't forget retail sales just around the corner, 25 minutes away. Then the last bank on Wall Street to report, the last big one, Goldman Sachs. That's coming tomorrow. In the FX market, dollar showing some more weakness against the euro for a 9th consecutive session. 112.57 on the euro against the dollar. We're positive there by 0.2%. And equities really not doing much over the last couple of hours, eh? We're down by 0.06% on the S&P.
Katrina Dudley joins us now, running real money at Franklin at Templeton. We're thrilled she could join this morning. How do you adapt and adjust here? We're talking about the mystery out 3 months. Frankly, the mystery out 3 years. How do you adapt here mid-year?
Look, I think we've been of the position for over a year that if we do have a recession, it will be what we've called a little r recession. I think now we're coming to the point where we're calling it the Godot recession because it's a recession that we're all talking about. We're all expecting it to arrive. And all of the data is kind of starting to show us that maybe we won't have that recession. We're talking about the strength of that job market, the fact that unemployment is persistently low, but you also need to offset that by the fact that the job openings, that JOLTS data, is stubbornly high. So there are so many openings for jobs that are just not being filled, which is why we think that unemployment number is going to be sticky and remain low.
So are you saying that you are getting convinced of this idea that we could see inflation get back down to the Fed's 2% target without the pain that Fed Chair Jay Powell was talking about last year in Jackson Hole?
I think that the definition of pain is going to be felt different ways in different parts of the economy. If we have a look at the worker has been under pain for 30 plus years, and now we're starting to see signs that the worker is being taken care of. So I think that they've already taken that pain, and they're now starting to come into their real time. If we look at the housing market, the data there on the starts has been positive. So it doesn't suggest that there's more pain to come there. The area where we are seeing numbers slightly weaker is in manufacturing, and that's where the debate is. But if you take a look at the stocks are trading very differently on a short cycle basis from where they have in the past. Industrial short cycles used to track PMIs, and they're not anymore. And that's reflecting the fact that people are looking forward, and they're looking at all the positive things that are coming through. And we've talked about them ad nauseum. The industrial landscape is very positive. So even if we have a slight pause in manufacturing, we think by 2024, we're going to be out of the woods.
All right, so then do you lean into this? Do you lean into industrials? Do you lean into financials? Do you lean into all the areas that haven't caught up with big tech this year?
I think you do. I think that you lean into investing. I think that if you are sitting on cash, you're making a call that you expect a recession to come in the second half or maybe the early part of 2024. And we do not see a deep recession that would justify you holding cash. So you need to lean into those parts of the market that haven't rallied as much as technology.
Katrina, you're one of the great voices on European stocks. You've seen the reaffirmation of Nestle, Siemens, all the rest of them as well. When we talk about quality blue chips in America, I think our audience has a real quality. What are the quality blue chips in Europe, and are they cheap to America?
I think you've just mentioned one of the quality blue chip names that we like, which is Siemens, which is an automation franchise. So it's a company that has recently sold off on a lot of those concerns that you're talking about manufacturing. It's also selling off because people are concerned about orders. These are companies that had very, very strong order books. Some of those orders they could not meet because of the short cycle, the supply chain issues that we saw. And so you're looking at a company that's selling off for what we think is the wrong reasons. So if you look over the pond and you look at its peer Rockwell Automation, you can just see the valuation disparity. And we think it's unjustified because we think Siemens, as you say, is a high quality player in the digital industries franchise. And it is the company that you really do need to beat if you're playing in automation.
Katrina, thank you. Katrina Dudley there at Franklin Templeton Series on the equity market and the economics of this moment. Here's a note just made for you, TK. What a title from Jim Reed over at Deutsche Bank. The soft landing beverage of choice, referring to the beverage curve and the relationship between unemployment and job vacancies. TK, the soft landing beverage of choice. You like that? You approve?
Mr. Beveridge was a force at LSE, and I would suggest underrated on single-handedly saving the institution. He did so with the Rockefeller Foundation of New York in America. It was going under in the Depression and into World War II. Beveridge has been a piñata within British economics for years, but he came up with this relationship of jobs and welfare. It's something David Blanchflower, as an example, or frankly, Janet Yellen is truly expert in the dynamics on. And the answer is the job market hasn't broken. And the relationship here to something, again, out of LSE, like the Phillips curve, it ain't working. And someone like, say, Jan Hatzius with his recession call, he's out there looking for what's the theory that works, what's the relationship that works. The traditional labor dynamics isn't in play right now.
Well, let's make it really simple, Tom. One of the hopeful objectives of this FOMC, led by Chairman Powell, was to get job openings down without sending unemployment higher. And so far, Bramo, we've managed to reduce job openings to a certain extent. I wouldn't say we've taken a massive chunk out of them, but ultimately unemployment is still in and around 3.5%.
And we continue to see jobless claims come in around 200 to 240, 250,000, and they haven't really sprung upward. So here's the question. Have we been pain-free? Or is, as we just were hearing from Katrina Dudley, are we hearing about pockets of pain in different places, the white-collar recession, the areas where there are layoffs? Is this the rolling kind of downturn that's really keeping a floor under how low things can go?
You know, Mike McKee is great on this. I mean, one thing that's great about Mike McKee to the beverage curve is Mike always has a beverage of his choice in his hand when he talks about the JOLT survey. But the answer is those statistics that we talk about on this show, folks, these talk about the employed America, the people in the game, you know, frictional unemployment, unemployed, worried about unemployment in the job.
Yeah.
There's a whole nother America out there that the politicians have to pay attention to that's really not within the Bloomberg surveillance
Pick a
dialogue.
sector right now. We've talked about manufacturing and recession, but service sector, tech sector, let's do tech. It's a big difference between owning tech stocks and working in tech over the last 12 months. Let's be very clear about that. Some of these major tech firms, we've seen cuts after cuts after cuts, big cuts to the workforce for some of these companies. From New York City this morning, welcome to the program. If you are just joining, on the S&P 500, we are negative by 0.09%. The next stop for this market comes in about 18 minutes' time. It's retail sales in America. And going into it, stocks a bit softer, yields a bit lower. We're down 6 basis points, 374.62. I wonder what would be the soft landing, hopeful, dreamy kind of data point that would drop, Lisa, in 17 minutes. What would that look like?
A little bit slower with respect to spending, but still robust. That yes, people are buying, but they're pushing back against price increases somewhat. The sort of, you know, happy medium of not too soft, not too hard, Goldilocks. Do we start hearing about that type of scenario again?
Goldilocks, Tom, you approve? Yeah. No.
Well, I mean, what else would be the ideal
Imagine
situation?
TK reading nursery rhymes to the kids.
Is that what we just
Not
sent it
too
to
hot, not too cold, and then it was just right.
I can just see,
they all went home.
you
Go to
see,
sleep.
seriously,
My dad, frankly.
can you see Janet Yellen doing Good Night Moon? Good Night Moon.
Sing it.
Good night, she'd have a ratio. Good night, the beverage curve. Good night, the Jolt survey.
Is she going to sing it?
No, she wouldn't sing it. It's a children's book, John, in
I
America.
don't know that.
You don't know Good
Really?
Night?
I have it memorized from when they were younger.
No.
It's a children's.
Is it a good book?
It's an American. It's deep.
sweet.
The movie was great.
What?
They made it into a movie.
No, it's like 3 words.
Sydney.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Earnings season is here.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
to re-weaponize food in a world where there are massive food shortages and people are going hungry and dying of starvation. I think the Russian action is reprehensible. If this is what Russia is intent on doing, then the rest of the world has got to, take action to make sure that we get grain out.
Mairead McGuinness there, the EU Financial Services Commissioner on Russia, the commodity market. This is how we set up this morning, going into retail sales 13 minutes from now. Equities just a little bit negative. We're down lower, softer by 0.08% on the S&P 500. Just want to take a beat and take a moment to sit on crude. $74 a barrel on WTI. We're positive by 0.4%. Year to date, we're down about 7% on WTI, down about 8% on Brent. Some people got this market right. One of them was Ed Morse of Citi, warning that oil bulls moving back into the market are making a mistake. He wrote this: the bulls have got it all wrong. The world is still waiting for a real Chinese recovery. Europe is in recession, and we still don't know if the US, Tom, will have a hard landing. Ed Morse pushing back.
Ed Morse is different than the others, and we talk to them all and have an immense respect. For example, the oil microeconomics of Goldman Sachs, an Allegiant Global Sense of Bank of America, maybe what we see from Emerita Sen over in London. And then there's Edward Morse. Yeah, he's global head of commodities research at Citigroup, but he does geopolitics and the larger view better than anyone. Dr. Morse joins us this morning. Ed Morse, I'm going to rip up the script here, and you allude to it in your research note. We are having a climate change 2023 globally to beat the band. Someone as giant as Michael Mann is really, really intense about this is a new climate change. How do you, with all of your expertise, interpret the global warming we're observing?
Well, it certainly has upended a lot of expectations. The world has decided to rely significantly more on solar and wind and on water. And part of the climate change process that we're seeing is disrupting that. The sun is being impacted by wildfires. The rain is not happening in the places that we need it. It's happening in places that we don't want it. And the wind stops blowing at the wrong time. So we are really in a power gen crisis that is global and is not going to stop anytime soon.
What will that do to price of oil and off the price, the supply and demand dynamics?
Well, the price of oil is still essentially that based on a transportation fuel market, not on a power fuel market. Part of the climate change surprise in 2021, reinforced by both climate change and the Russia-Ukraine war in 2022, is that we had a surge in natural gas prices, and it made diesel more expensive because there was fuel switching to meet the ban between natural gas and diesel. So that's the first time that we've seen a spillover effect from the power gen market into the transportation fuel market. And it's not going to be the last time that that's happened. But that separation that we used to think of as automatic is no longer automatic. And when we get into the next crunch on that gas, which might well be in 2024, we might see that happening again. Meanwhile, between the obstacles to invest in fossil fuels and the reduction in demand that we're seeing, that spells volatility ahead. It spells a market which will be moving between supply shortage and supply oversupply on the oil side from year to year. And the oversupply won't be big enough to get us down to $20, or let alone negative prices. And the undersupply won't be big enough to get us over 100. But it will mean volatility in the market is going to be there as we go through decades of an energy transition.
So what's the range then? The band is from $60 to $100 a barrel?
I'd say there's a soft put at around 70 at the moment. That soft put exists not only because we have OPEC, which really doesn't want oil below 70 and are proven to be able to take action, but we have the U.S., which has basically announced that it will be more aggressive about filling the strategic stockpile. When we get to 70, we have China that has, since the 2008-9 great financial crisis, decided to build inventories when prices are low and to use those inventories when prices are high. So I think we have a soft put at the moment, higher than 60 and maybe at the 70 level. On the upper side, you never really know what happens. there are wild cards. Hurricanes are certainly wild cards. All we need is 2, 3, 4, 5 category hurricanes in the Gulf of Mexico, and we get damage like Hurricane Harvey or Rita and Katrina year, where refineries are out for 4, 5, or 6 months. The U.S. is the heart of the global fossil fuel market. The U.S. Gulf Coast is the largest contributor to combined oil and gas in the world.
Yeah.
We are between oil, crude, and petroleum products now seeing 9 or 10 million barrels a day of exports, most of that coming out of the Gulf Coast. And that's larger than the total production of either Russia or Saudi Arabia. And we're seeing 15 BCF a day of natural gas coming out of the U.S. Gulf Coast. Flooding can knock all of that out for a while. So we have that wild card sitting there. But without the wild card, I'm comfortable thinking 90 is a real ceiling for whatever we see on the tightness side of oil for the time being.
Ed, where does a soft landing versus a hard landing fit in from the U.S.? You said we haven't really priced in something of a more honest recession in the U.S., which a lot of people are discounting altogether. What makes you think we shouldn't?
Well, partly because of my colleagues Veronica and Andrew, who you were talking about earlier, and you know, I believe what they say about where economic growth is going, and I tend to believe people like Larry Summers, who are among those pushing for the hard landing scenario. But there's something secular going on as well. We had lower oil demand last year in the United States than we had the year before, and that's by every measure on almost any product other than this category, what we call other. But we had less gasoline demand, we had less diesel demand. We're seeing a pickup in gasoline demand this year because people are taking vacations more than they did last year, but we're not at 2019 levels yet, if we ever will be there again. We're really seeing a phenomenal structural shift, both in gasoline and diesel in the U.S. The diesel side of it is partly related to the efficiency of trucks. More importantly, there are 2 things structurally going on. If you look at, you know, those of us living in New York and looking out on the street and seeing delivery vans, they're mostly fueled by cleaner energy than diesel. They're mostly fueled by either hybrid vehicles or electric vehicles or natural gas vehicles. So that plus the actual drop in trade, we have, you know, a lower level of container ship movements since last September. We have onshoring going on in the United States and in Europe to take away from China what has been a significant part of their exports. We're seeing a slowdown in trade, which means a slowdown in trucks going back and forth to ports. Between the change in the fuel stock and the change in the trade environment, that's a really permanent factor in the market. On the gasoline side, one of the biggest issues is, of course, the increase in fuel efficiency. And we didn't expect the increase in fuel efficiency that we've seen, but certainly during 3 years in which we had supply chain problems in the auto industry, auto manufacturers were selling either the most fuel efficient and therefore the most expensive ICE vehicles they had, or selling more electric vehicles. And the fuel efficiency of the U.S. has gone up a lot in the last 3 years. And on top of that, we're having a record amount of retirements. And with that, fewer people with 2 or 3 and going to more people with 1 or 2 cars. And they're driving less, even with the labor market statistics. So balancing that are other factors. And I think we're very close to the U.S. joining China and Europe in reaching oil demand coming sooner than most people expect.
Ed, we've got to leave it there. Fantastic assessment, analysis on the commodity intensiveness of economic growth. Ed Morse there of Citi. 5 minutes away from retail sales in America. Mike McKee and more coming up.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Surveillance. Good morning, everyone. John Farrell getting ready for our next 9 o'clock hour. Mr. Distenfeld will be joining John. That is a good thing as well. Lisa Bramwitz and Tom Keene here with economic data. And Lisa, it's, I guess, disinflation retail sales because it shows retail sales top line in inflation, but maybe there's less inflation, so maybe I'm making this up as I go.
Well, there's some expectation that auto sales will cushion the numbers just a bit because of some sales, but that there won't be the same kind of underlying strength that we've seen in prior readings.
Maybe because with this inflation coming down, we're delaying because Michael McKee is searching for what retail sales will be doing here. But there's a mystery here, Michael, seriously, before you get the numbers, because we're disinflating into these numbers, right?
Yes. I mean, inflation has driven retail sales over the past couple of, last year, basically. The first number comes out, advanced retail sales up only 0.2%. That would be down from 0.3, although I don't have any kind of revision yet. And that is much lower than the 0.5% that was thought. Ex-autos were up 0.2. Now, there was a thought that the feeling going in, according to economists, was that autos were going to drive that bigger headline number, but it appears to be not the case. Take out gas and you're up 0.3. We're still waiting for the control group to come down, but it is not the kind of performance that economists expected, and because we have a slow internet, it's hard to get
let's wait for the numbers.
Let
me show the markets here right now. Michael, I'll come right back to Michael McKee when we get this important data, because we have a substantial market move with yields lower. 2-year yield bombs down 7 basis points. Big move, 4.67%. 10 years, 3.74%. Lisa, critically here, I had a 1.49 on the 10-year real yield. This is a disinflation half a report so far. We're still waiting for the meat of it.
Right.
With Michael McKee.
Bad news is good news, although we are getting some more data. Mike?
Yeah, the meat is much better. The control group, which takes out gasoline and takes out building materials and autos, is up 0.6. So there's a weakness in one of those three areas that we haven't seen yet, and I'm going to be looking for that while you guys are chatting for just a second.
We're seeing that move lower in yields, Tom, but I do want to pick this out as well, that U.S. May retail sales were revised upward from 0.3% prior read to 0.5%. So even though the headline number came in slightly softer than expected, revisions upwards in the prior month. This is not a clear-cut report, especially with broad-based gains outside of the gas and the auto sector.
Yeah, it's a mystery still. We get the revisions, and here are the revisions. I feel like I'm doing Miss Universe or something.
Yeah.
Continue, Mike.
The numbers for May, the headline number revised up to 0.5% from 0.3, and the control group revised up to 0.3 from 0.2, and that comes in at 0.6. I'll give you where the headline fell short. this is much better news than you would have thought. The advance number for gasoline was down in terms of the overall number, 1.4%. And economists had thought that maybe gasoline would add a little bit to this. So that's one of the areas in which we see some weakness. Motor vehicle sales, 0.3 in June of 2002, we were seeing 5% changes. So not a huge change in the motor vehicles area, but we did see declines in health and personal care stores, gasoline stations, as I mentioned, sporting goods, and general merchandise stores, department stores down 2.4%. So people pulled back on some spending, but there is still spending out there.
Within the mess of this announcement, no fault of Michael McKee's, it just took a while to get it out in a clumsy way, but we had yields in sharply, now yields reversed, 10-year yield reverses as well. How does this data, this information, Mike, this late in the quarter fold into the Q2 view?
Well, it will go into the Q2 view, but less than the retail sales report is not a real component of it. The control group is a proxy for retail spending, but remember, this is mostly goods. So it's the personal consumption number that we get at the end of the month that will really be the number that people want to see, because we want to see if services spending went up.
Michael McKee, thank you so much there. And retail sales gyrating and swinging, your 2-year yield was in a full 7 basis points and now is in only 3 basis points after the revised numbers. As confused as we are, but never confused, is Jay Bryson, chief economist at Wells Fargo. Jay, wonderful to have you with us. I think that states the confusion right now. Does Wells Fargo have clarity on what the American consumer is doing?
Clarity, that's a strong word, Tom. But I guess in general, when I stand back and I look at everything here, there has been some deceleration in consumer spending. Consumer spending in the first quarter in real terms grew over 4% annualized. We're just not going to get that in the second quarter. We came into the second quarter with some deceleration. These numbers that Mike just talked about, I mean, on balance, I think they're okay. But in general, it doesn't change the big story that there has been some deceleration in terms of consumer spending out there.
Jay, how much has the overall discussion been completely distorted by the auto sector? How much the prices just shot upwards in the aftermath of the pandemic and now are coming down and resetting, especially as auto loan rates are getting so high? How much is that behind all of the confusion?
Well, Lisa, I wouldn't say it's a huge part of it. I mean, so if you break down consumer spending, roughly 2/3 of consumer spending is going to be on services. And the other third is split roughly equally between non-durable goods. So that would be like clothing and shoes, et cetera. And then durable goods, what component of that is autos. So it moves things around on the margin. But again, the big driver of consumer spending growth in the economy is services. And I think that has been, in some sense, more distorting over the last 3 years, in the sense of when the economy was shut down, the service sector was shut down, and then that came roaring back last year as the economy opened up, all this pent-up demand for spending, and a lot of that now is pretty much behind us right now. So we hopefully are getting to the point where things, the aftershocks of the pandemic in terms of the economy are now settling out.
Okay, so the aftershocks are settling out. What is the new economic trajectory when it comes to inflation? Is it back to what we saw previously, or is it something different, especially if people are getting paid more and they're not pushing back as significantly as some would like with respect to how much prices can keep going up?
Well, I may differ a little bit on that. I mean, I think you are seeing some signs of that right now. I mean, we are seeing it in terms of deceleration, in terms of inflation out there. It's still slowly coming through in the service sector, but if you look at the rate of change over the last 3 months, you're seeing less service sector inflation as well. I mean, our view here is that we are heading back towards 2%. Now, it's not going to be right away. It's going to take a little bit of time, and part of that is predicated on some economic softness, i.e. a mild recession early next year. But, I think these 9-10% sort of numbers that we saw, or even 5%, I think that's a thing of the past, and I think we're heading back towards a 2% sort of era.
Jay, on the international basis here, and after the clumsiness that we see here of American retail analysis, do you have a clue what the Chinese consumer's doing? I mean, we sit there, guys like you.
Again, as I said earlier, when you look at overall retail spending, it's roughly a third of the U.S. Of spending. You know, the big component is the service one. So what we pay much more attention to is the numbers that we're going to get at the end of the month and the personal income and spending. That's when you get the service sector components, and you get real numbers as well.
So just putting this all together, are you increasing albeit less than they were, albeit less than they were.
3%, 10-year yield 3.78%. Red on the screen, but nothing inflammatory. The Standard & Poor's down all of 0.1%. We say good morning. Lisa Bramwitz and Tom Keene, John Farrell preparing to drag us into the market. Opening here on television and radio, really looking forward. Howard Ward will join us on radio. I'm really excited to get his equity update, his courage to be in the market. Our ability is to speak to Michael McKee. And Michael, the economist Sam Rowe has out on Twitter a great observation, which you are expert on. Online, up 1.9%. Department stores down 2.4%. That's a ginormous 4 percentage point delta between where we're going and online. How does technology overlay our retail sales? It just seems to me that this observation from Sam Rowe of buoyant online, department stores flat on their back speaks volumes.
Well, we did see a big shift to online, obviously, during the pandemic, and people are still doing that. There's been some obituaries written for the brick and mortar stores that seem to be, from recent earnings, a little premature. People like to go out and try on clothes and try on shoes and things like that, but it is true that in this latest month, department stores were down significantly, while non-store retailers, the online folks, were up. And department stores have been struggling the past 6 months or 8 months, as you know, they aren't seeing the same kind of traffic that people saw.
I think for the American economy, on 12 months, folks, or for that matter, on 12 years, that's an extraordinary trend. Just that across 30 days in June. Futures at -6, Dow futures at -32. The VIX stable, 13.60. Thank you, Ed Morse, for wisdom on climate change. Brent crude, 78.57. This is Bloomberg Surveillance. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
China has a huge potential, but it's actually still quite a small market for you.
It is still small for us. Yeah, huge short, mid, and long-term potential for us. So it's about 6% of the company today. We're being very deliberate in our approach in China. So we could grow faster, but we want to do it in a quality way. So we're building the brand. So that serves us well 5 years from now, 10 years from now. But I'm very excited about just more generally Asia and China.
Patrice Louvet, Ralph Lauren's CEO there, as they continue to look at luxury and the partitions of luxury as well. Good morning to Dana Telsey. I mentioned her earlier, Telsey Advisory Group, with their work on LVMH. There'll be a lot of that coming out as well. We're going to digress here away from the Fed, away from the view from 60,000 feet, and actually talk about what America's doing. Chuck Graham is hugely qualified at Gordon Haskett to talk about this, and he's hugely qualified to know that what you do is you pay attention to what the people at Adobe are doing. Adobe owns a high ground of the micro-analysis of every transaction out of the Abramowitz household. This is a known and beautiful thing. Mr. Graham joins us this morning. On Prime Day, away from all the mathiness of it, Chuck Graham, what was the single message you learned?
I think that the single biggest message is that Target looks like it was a real disappointment on a year-over-year basis. And when we compare visits to other retailers on a multi-year basis, they were really just look like they disappointed. So we're clearly seeing some mean reversion for Target on the sales front. I think that was the biggest takeaway.
As you look just generally at retail sales following the retail print we just got out of the U.S. government, there is a question of whether this is good deceleration in consumer spending or bad deceleration, meaning that they're running out of appetite to buy. Which is it?
Well, we actually are looking at on a 4-year basis. I know that the headline numbers are on a 1-year basis, but if you really compare it to 2019, the June numbers actually look pretty good. We're talking about over a 300 basis point acceleration relative to the month of May. And we track things across, close to 15 categories, and every single category that we look at actually had an acceleration. So we're actually taking a little bit of a different view. I'm still kind of crunching the numbers that they just did, like you said, a few minutes ago, but overall they actually look pretty good.
When you say pretty good, is it across the board, or is it just outside of autos where people loaded the boat already? And you strip out that kind of sector, and people are spending more in retail. You're seeing that in some of the results. They're spending more certainly on travel. We heard that from Ed Bastian over at Delta.
Yeah, there's no doubt about that. I think, but to your point, earlier in the conversation, digital definitely looks like it's a bright spot. Department stores look like they're a weak spot. Is that new news? Really, no. I think what the interesting takeaway is, if you look at a couple categories that have been weak over the past 18 months, categories that have been on the downslope of that mean reversion, CE looks like it was a little bit better. Home furnishings was certainly a little bit better. So we're taking a little bit of a more optimistic approach here with the June numbers, and it actually dovetails nicely with, Tom, you mentioned some of the Adobe statistics. We look at a lot of footfall data. Our survey work that we do definitely showed throughout the month of June some uptick relative to the prior, say 2 or 3 months.
Chuck, I know when you were at the College of the Holy Cross, when you were board stiff, which, at the College of the Holy Cross, Worcester, Massachusetts, you go down Route 9, you go down Flutie Way, you go over to the Natick Mall, and you look at the future of America. Is the Natick Mall or any other ginormous mall the future of America when you look at the mathiness you study of omni-channel? Is omni-channel working?
Oh, it's unequivocally working. And you're seeing more digitally native brands start to open up retail stores, and obviously retail stores have adopted digital. And, I know Target's going through a tough patch right now, but during the pandemic, they really accelerated their online pickup and drive up business. And so it's clearly intermingling of the stores in the digital world that's working and will continue to work.
So I think there is a place for malls.
Every day as well. I mean, I think that obviously Amazon's winning. I think what we're more focused on is the brick and mortar guys. And I think a company like Walmart, through its Walmart Plus and Walmart Connect initiatives, is really catching up very quickly. The number of SKUs they're offering, the speed that they're delivering. Right now, Walmart's in a really enviable position because people are trading down. More affluent people are shopping with Walmart. And unlike 10 to 15 years ago, when Walmart gave most of those customers back, we think they've got a great chance to hold on to that customer base.
To me, there's a new vengeance here, Lisa, with the tensions out there, particularly coming off inflation. People, and particularly up the food chain, they're hyper-focused. One thing in the kitchen, two things in the kitchen, one thing in the bathroom, one thing in the bedroom. They're hyper-focused on where this is going.
Which is exactly what I wanted to ask you about, Chuck. You said that more affluent people are trading down. We did hear from the likes of Richemont, of Louis Vuitton, that basically in the U.S., luxury consumer is pulling back just a bit. How much is this a persistent trend that's benefiting the Walmarts of the world, but maybe not so the luxury players that had benefited disproportionately over the past year or so?
I think that you're going to continue to see it to a degree. I mean, I think you touched on it earlier that the consumer is generally healthy in this country. Balance sheets are in great shape. People have more savings than they did several years ago. And I think the real inflection here is that real wages, when you strip out inflation, is really starting to see an uptick here over the past few months. And we think that potentially bodes well for the holidays and into 2024. If we start to see this inflation really start to cool, that puts more money into people's pockets across the board, no matter what the income demographic is.
Chuck, got to be quick. Single best buy. Let's go back to Stern Agee, Deutsche Bank, JP Morgan, all the awards you've won over the years. Single best buy.
Over time?
No, I mean right now. Single best buy,
right
moving
now.
out.
Over time, been Costco. I think Walmart's the best name on the board right now, also followed by TJX.
Even Walmart with a 20-plus PE multiple?
I think earnings are about to inflect significantly, but we'd barbell, so I'd take TJX on the other side. I think both names you can make money before the end of the year.
Chuck Graham, valuable. Thank you so much. Chuck Graham, legend. Gordon Haskett here this morning. That's real retail sell-side talk. How much do I hate the phrase omnichannel? The moment I heard it, it's never rung true. What is omnichannel? I mean, I get it, but still,
many channels. I wonder if this also just means that people go to the store, try it on, and then order it online so it comes to their door. I do want to reset just a touch because we are seeing the market reaction as we do get the Bank of America earnings call, and after the earnings have come out, you're looking right now at Morgan Stanley shares that have pulled back and retraced almost all of their gains after
the other day. But, folks, I've really never said this in umpteen years. The earnings season for banks is barely started. We had Thomas Schode with us at KBW yesterday, and I'm sorry, this is a KBW Sandler O'Neill season. These regional banks and these smaller banks tell us a lot about the linkage here of finance into economics, and I hope ultimately over to Dow 34,727.
I take that point because PNC shares lower by almost 3%. That has been a move that stuck because they brought down some of their expectations for future revenues. And they also saw that bleed of deposits going out, just like you saw that also at the big banks.
I don't have the math in front of me, but again, Bank of America with a great PowerPoint. There's the money that people want to earn on their yield right now, on their cash, and there's what banks are willing to pay. And there's a little, I don't have the numbers here, I'm sorry.
I'll give you some numbers.
Chanel,
Bank of America, total deposits fell by 5% from a year earlier, 2% from the first quarter to $1.9 trillion, not exactly crying for them. Non-interest-bearing deposits fell 24%, while interest-bearing deposits rose 5%. People are sick of not getting paid at a time when you've got a Fed funds rate north of 5%.
There's no question about that. I mean, you see it with the money market funds as well, that hinging, let's say, off the 3-month T-bill, 5.35%. That's stunning, 5.35%. I mean, with any kind of Jim Bianco undisinflation, you get that out near 6% quickly. 2-year yield, 4.70%. A 10-year yield in 5 basis points, 3.75%. Curve noise today in the inversion space, 95 basis points. it's germane. It's something to watch here as we go through the week into the Goldman Sachs earnings tomorrow, and the real yield 1.52%. Much to come up. Goldman Sachs earnings tomorrow, but in between at 1:30 p.m. this afternoon, Arshanale Basak with James Gorman. He is the leader of Morgan Stanley. That will be most interesting. From New York on radio, on television, this is Bloomberg Surveillance.
What we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. You know, we don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Live from New York City this morning. Good morning, good morning. Equity futures on the S&P 500, negative just a little bit. We're down by 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, Wall Street banks deliver another round of beats. Retail sales in America showing some resilience as Secretary Yellen sees disinflation pressures at work. We begin with a big issue, faith in the American consumer.
The consumer has been strong and
resilient.
They're doing great.
The consumer continues to outpunch expectations. They're just really on the upswing right now.
Inflation has been coming down.
Consumers are feeling considerably more confident now.
You're seeing this kind of breath of relief.
The question is, how long will that extend?
Eventually, the U.S. consumer is likely to slow.
We've seen consumer spending slow.
We're concerned about the consumer in the second half of this year. It really depends on what happens to the labor market.
The labor market remains relatively strong.
If you start to see some cracks in the job market, if labor market expectations unravel, the consumer will slow. That is the wild card.
As long as employment remains strong, then the consumer still has some legs.
Joining us now to discuss AllianceBernstein's Gershon Distenfeld. In just a moment, Jim Bianco of Bianco Research joining us as well, and Mike McKee's going to break down the data for us from 30 minutes ago. Gershon, first to you. Retail sales showing some resilience. We've had a week of downside surprises on the inflationary side of things. Do you subscribe to this theory that a soft landing is just around a corner?
I'm not even sure what a soft landing means, but I think your point, John, is the consumer has been very resilient here. And, maybe the Fed's performing a Houdini act here, and maybe they're going to get it exactly right. But markets seem to be a lot more nervous about that. And I think we're more nervous about that also. However you define a soft landing. There's, a month ago, we were sitting here feeling a lot less confident about that. Now, all of a sudden, we're confident. I think we take these short-term numbers that we see in the marketplace way too seriously. We got to look for prolonged period of stability or keep on seeing inflation pressures abate while seeing unemployment stay low and the consumer stay strong. We see that for a few months in a row, we'll start to get more confident that the Fed here has orchestrated what people are calling a soft landing.
Gershon, listen to the happy talk of the last 24 hours. Jan Hatzius over at Goldman cutting the probability of a U.S. recession from 25% to 20%, saying the main reason for their cut is that the recent data have reinforced their confidence that bringing inflation down to an acceptable level will not require a recession. Even the likes of Marko Kolanovic over at JP Morgan saying the downside CPI surprise means a narrow path to a soft landing is modestly wider. I've heard something similar from the likes of Seth Carpenter over at Morgan Stanley. But let's be clear, there's some pushback out there, including Citi, Andrew Hollenhorst, Veronica Clark. Soft landing optimism is premature. I wonder where you stand on this one, Gershon. This full quote from Andrew Hollenhorst, let me share it with you. Tight labor markets, elevated wages, upside risk to shelter, and other services inflation means we don't share this optimism. Absent a tightening of financial conditions, inflation may re-accelerate in early 24. Gershon, I don't know about you, but I struggle with late summer, never mind early 24. Where are you on that?
I think we have to, again, we've seen 1 month, essentially, of easing pressures. We need to see more of that. And the reality is that, we've seen a tremendous amount of tightening in financial conditions. There's a lag on that. We know that. If you remember, the Fed only got to kind of 3%, which we would consider neutral, about 9 months ago. And, most people think monetary policy works with a 6 to 12-month lag. We have to see. One thing I do think that, whatever happens in the short-term inflation, there are secular reasons having nothing to do with kind of the cyclicality we've seen over the past few years, which will make it very difficult for the Fed to get inflation down close to a 2% target. And that's just the two global trends that we've seen. One is the rise of populism. I'm not here to make a political statement whether that's a good thing or a bad thing. There are people on both sides. One thing it is inflationary. And the second thing is kind of what we'll call deglobalization. People like to blame former President Trump, which he was certainly guilty of. But there was a trend well before Trump of countries really, restricting trade, bringing things closer to their borders. That, too, is inflationary. So I question whether we're really going to get on a secular basis back anywhere close to the 2% level. The final point I'll make, John, sorry for blabbing on here.
No, please continue.
Final point I make is I think, we got to talk about real rates. There's been so much focus on inflation, which is understandable. It's been the key topic for the past couple of years. But we've seen real rates rise quite a bit after being at zero or negative for quite some time. So it's not clear to me that even if inflation comes down a tremendous amount, we're supposed to have materially lower rates.
Let's bring Jim Bianco into the conversation of Bianco Research. Jim, you've been making the argument that inflation is bottoming. Now, I want to be very clear on that. You believe that the disinflation over the last few months will prove to be transitory. Jim, it's some real pushback to the happy talk of the last week or so. Can you give us some detail on what backs that up?
Yeah, a couple of things. I think, first of all, that there's a
base effect coming. You know, we talked about that big a year ago when we hit 9%. Well, this is the flip side of it, that we hit 3% on the year-over-year basis. August of last year, July of last year's inflation rate was 0. August was 0.2. Those could be easy to jump over. So the year-over-year inflation numbers should probably trend higher unless you tell me the price of gasoline or crude oil is about to take a serious dive, which I don't think it is. Beyond that, I want to agree with what Gersten was saying, that we did something extraordinary 3 years ago. We shut down the global economy and restarted it. Even a week before we did it, we didn't conceive of that even being possible. We're going to be spending the rest of our lifetime trying to understand the ramifications of that. And that's going to lead to persistently higher inflation for many years. Not 10, 12, 15% inflation, but more like 3 or 4% inflation. And if we were to see a world of real rates returning positive, we could see higher. So yeah, I think 3%, maybe high 2s, is about all we can ask for in inflation right now over this cycle. And I wouldn't be surprised if it starts trending higher and then you throw in positive rates. And we're not quite done with this cycle yet when it comes to inflation.
Well, Jim, are we not quite done with rates either? Do you think more hikes are coming than some people think?
Yeah, I think so. For July, it's almost 100% priced in that we're going to have a hike next week. The Fed has promised 2 more hikes. I think that as we see the inflation rate move higher, as we see talk that there's not going to be a soft landing, which would increase the idea that there'd be a push on inflation, that second hike will come in. And I wouldn't even be surprised if we see more hikes beyond that. This cycle's always been about people underestimating the Fed. We've been underestimating the Fed for 18 months. It's very hard to overestimate the Fed. So when I say 3 hikes, I know everybody goes, wow, 3 hikes. But that's kind of the way this cycle has been for the last year and a half.
So, Jim, what's the pushback to this? This came from Capital Economics about 10 minutes ago. Let me share the quote with you. Excess savings are all but eliminated. The impact of higher rates and tighter credit conditions are gradually feeding through. Student loan repayments are scheduled to resume. We would argue, they would argue, consumption growth will continue to underwhelm in the second half of this year. What would you say to that?
I wouldn't disagree with that. I think that while you could get positive growth, it would be very tepid at that point. But I'll come back to what I said earlier. This is a different economy. It is a post-pandemic economy. And we are still trying to understand work from home, the deglobalization that Gersten mentioned, the politics that we've seen around the world. All of this is feeding into a much different economy than the models told you it would be if you were using a 2019 axis on it.
22 minutes away from the opening bell. Equity futures right now, negative 0.1% on the S&P. If you are just tuning in, welcome to the program. Retail sales in America around about 38 minutes ago. Mike McKee working through this. Mike, the data, we got a drip feed of it. Control group, actually not that bad.
Yeah, it was kind of interesting to see the reaction in the markets. You look at the 2-year yield that came out and immediately fell because, we had worse than expected numbers. But then everybody looked at the prior month revised up big and said, well, maybe things are better. And now we're kind of, we're about where we thought we would be, which is a healthy pace of growth, not as fast as it was. But June at 0.2 for the headline number, but the May number revised up almost doubled to 0.5%. And as you mentioned, John, the retail control group, very strong, 0.6, and the May number revised up from 0.2 to 0.3. And that's the part that goes into GDP. So that's the part that economists are focusing on this morning. Does this continue? That's the question the Fed's going to have to answer. And there's a pretty good chance it could, because if you look at spending, consumers are now on an average hourly earnings basis adjusted for inflation, finally getting ahead of inflation. So they've got some money to spend, and businesses are also investing, and we're starting to see a lot of structural spending. So at this point, it looks like the economy doesn't have a particular reason to slow down, even if the Fed raises rates one more time. Now the question is, do consumers continue to spend the way they have been? Do businesses continue to spend the way they have been? Or is there something that will push them back? And so far, we really haven't found it. Interesting shift in spending this last month, John, because we saw a 1.9% increase in the online sales category and a 2.4% decline for department stores. People shifting to online, even though Prime Day was this month, so that's kind of an interesting move. Most of the notes I've gotten, by the way, say people are maybe lifting their second quarter GDP forecasts out of today's numbers.
Mike, we're talking about consumption. Let's talk about credit that underpins some of that consumption. There was a release yesterday from the Federal Reserve survey that's done, I believe, every few months. This is the latest edition of their survey, published every 4 months to be precise. It read like this: the rejection rate for loan applicants jumped to 21.8%, just sharing the numbers now, in the 12 months through June. That's the highest level in 5 years. They also said the overall credit applications declined to the lowest level since October 2020. Mike, I've asked a couple of people the same question. I'd love your response to it. How do you read that survey from the Federal Reserve? What is that telling us?
Well, it's definitely telling us that people are not going to be able to charge up as much or borrow as much as they had previously. Do they need to do that? Do they want to do that? Have they bought enough stuff at the moment? And are we going to settle into a lower level of spending? But it's not unexpected with the Fed raising rates the way it has. Banks are getting tighter on credit. And so we're seeing people get rejected more often. And probably a lot of people don't want to pay the higher rates that you're getting these days. So maybe that gives you some reason why we're seeing a decline in applications.
Mike McKee, thank you, sir. On the latest data in America, yields a little bit lower. We're down 4 basis points, 377 on a 10-year. On a 2-year, yields down 3 basis points to about 471. Gershon, the gains have been in the equity market in a major way so far this year. The S&P's up like 18% year to date. The Nasdaq's up something like 36. The Nasdaq 100 up even more. Gershon, I was reading your notes. This line here: avoiding bonds could be a costly mistake. Gershon, can you give me a bit more detail? What's the message there?
Well, the message there is that bonds are a much more mathematical asset class than others. And the reality is, even though we may have elevated rates for a long time, the starting point matters. And the starting point is much higher. Certainly the short end of the curve looks very attractive. And the long end of the curve, I think, again, as I mentioned before, and as Jim really highlighted very, very well, you know, everyone's been behind what the Fed is going to do for a long time. So this idea that we're going to have continued volatility in the short end is not necessarily the case. So, you know, we think that bonds are back, so to speak. And, you know, I'm not making a prediction over the next couple of months, but, you know, what happened last year, not that we thought it was going to be as bad, but when you started with a 10-year under, you know, 1.5%, you almost couldn't get very strong returns. We're at yields now across the spectrum, going out even into corporates, emerging market debt, and other parts of fixed income, where the total return you're going to see, or the potential at least, is a lot higher than it's been for most of the past decade.
So, Gershon, help me understand, if you're in cash at the moment, are you taking additional credit risk? Should you take on duration risk? And starting point does matter, to your point. So let's say we're starting right now, not 6 months ago, but starting right now, and I'm looking at spreads that are near the tights of the year. What's your advice to people right now?
Well, look, I think we're certainly not, people seem to be very, very bearish on credit. We're certainly not pound the table bullish, but to the theme again, starting point matters. Companies are in much better shape. So I think there is room to take credit risk, but you have to have a longer term view on it. One thing I think is interesting, John, is that, you know, people are talking about if we go into a cycle, whether even if it's a soft landing, or certainly if it's something harsher than that, we're going to end up having a lot more defaults. I think the default rate is going to tick up regardless, because it's not so much the cyclical stuff. You look at the last 2 default cycles, and just energy itself was over 50% of the defaults. It was mostly the cyclical companies. That's unlikely to happen this time. What's happened is that private equity firms for the past decade, after the global financial crisis, they've really they have not wanted to lever up the cyclical companies. They've gone more for the safe type spaces, you know, healthcare, technology, cable. But there's secular pressures there, and there's a lot of leverage there. So it's not as susceptible to the, you know, ups and downs of the in the moment cyclical cycle. But we are expecting to see defaults tick up. But some of that is really priced in already. So do I think you're going to get some of it all? Do I think you're going to get great returns going out to credit? Probably not. But you're also unlikely to get kind of disastrous returns that some people are predicting.
Jim Bianco, you're on the other side of the popular debate right now. You know the popular narrative: soft landing, soft landing, soft landing. We've talked about it. consistently over the last week or so. Jim, you're pushing back against that, but I wonder if the trade you'd put on right now in the equity market is any different to the popular one, the consensus trade. If you're right that inflation continues to be a problem through this year and maybe beyond, if Andrew Hollenhorst is right over at Citi that it reaccelerates in early 2024, in the words of Mohamed El-Erian last Friday, is this soft landing narrative something you want to fight? He says it's not. Jim, is it?
Yeah, I would agree with El-Erian. I think, let's break down the stock market real quick. Yes, the S&P's up 18% this year, but 493 of those stocks collectively are less than 4% of that gain, and 7 of those stocks are about 14% of that gain. What does that tell me? That tells me that the broad narrative of the market is more consistent with this idea of a struggling below average economy that might even face some more headwinds like inflation. The vast majority of stocks are not really doing a whole lot. Yes, the NVIDIAs, the Apples, the Microsofts of the world are powering higher. The Googles of the world are powering this market higher. But those aren't really, I don't think, representative of the broad swath of the economy like the other 493. So if you were to talk about the idea that there could be a soft landing, but that really to me says below trend growth, and that's I think what we're seeing out of the stock market, at least the vast majority of it.
Jim Bianco of Bianco Research, Gersten Distenfeld of Alliance Bernstein. Gents, it's been too long. It's fantastic to catch up, to break down these markets and talk about this data. More data in America, this time industrial production coming in softer than expected. A downside surprise, we're negative 0.5%. The median estimate in our survey was something flat, so it's a downside surprise there. Downside surprise there as well on manufacturing production for the month of June. Equities stay a little bit softer. We're negative 0.1% on the S&P. Yields taking another leg lower at the front end. We're down about 5 basis points on a 2-year to just south of 470. Let's get you some movers going into the opening bell. We can do that with Katie. Morning, Katie.
Morning, John. Let's run through some of these bank earnings because it was a busy morning. I want to start with Morgan Stanley. You had trading revenues slide 22% from a year earlier. Deal making down as well, but record wealth management revenue cushioning that blow, as you can see in the stock market. Bank of America shares on the rise after trading gains boosted second quarter profits, helped the bank to beat estimates. You can see that in the shares. I wanted to end with PNC because it's a different story. It kicked off regional bank earnings, cut its full year guidance, citing higher deposit costs, lower loan growth. You can see that is hitting shares. And Schwab, just really briefly, up 7.5%. Big pop after the bank deposits beat estimates. Of course, that had been a worry for that name. You're seeing a relief rally now.
That's a big move, Katie. Thank you. More from Katie Greifeld going into the opening bell. So many bank earnings so far this morning and over the last week. You'll get more regionals between now and tomorrow. And then tomorrow morning, the focus shift to Goldman Sachs just to wrap up the earnings season so far for big banks on Wall Street. Coming up, another round of better than expected bank results.
Banks are paying up everywhere for deposits. We really haven't seen a big dichotomy between large and small. I think every institution across all asset sizes are paying up for funds, and so that is being translated into much more stable deposits.
Coming up on this program, Bloomberg Sonali Basak breaking down the latest from Morgan Stanley and Bank of America and anticipating a conversation with the chairman and CEO, James Gorman of Morgan Stanley, with Sonali a little bit later this afternoon.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does We're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Banks are paying up everywhere for deposits. Bank of America has the best deposit base in the country, and so that gives them a leg up. I mean, they have access to consumer funds that are cheap, and they have a big advantage over Fed funds, as I mentioned earlier. I feel that they've got a lot going for them.
Another round of U.S. bank earnings topping estimates. Bank of America's fixed income and equity traders delivering an upside surprise. Morgan Stanley's wealth management division posting a record revenue. CEO James Gorman saying the firm delivered solid results in a challenging market environment. The quarter started with macroeconomic uncertainties, but ended with a more constructive tone. Bloomberg's Shanali Basak has more. Hey, Shanali.
John, when you take a look at the numbers, they're pretty clean across the board. There are some areas where the banks have missed a little bit, but they are getting grilled on that on the calls right now. When we take a look at Bank of America, they have raised their net interest income guidance for the year. They're expecting to bring in about $57 billion this year. Let's put that into comparison for a second here, because that is $14 billion more than they made for the full year 2 years ago, 2021. Compared to JP Morgan, though, the $14 billion you're seeing in a rise at Bank of America compares with a $34 billion rise over that same period in JP Morgan. So seriously, a lot of competition in net interest income, bringing on new clients at a time where you have Brian Moynihan saying the consumer is slowing down. They're not slowing down dramatically. They're slowing down back to pre-pandemic levels. So it's nothing crazy to see there. And even when you look at the charge-offs that they're taking, they're not ticking up so highly that you're worried about those costs. You are worried, however, about other costs. Brian Moynihan saying that operating leverage is trending in the right direction, even with spending about $2 billion more in technology expenses. He's saying artificial intelligence, really technology spending is going to drive revenue higher, even with those increased costs tied to regulation, the FDIC, and so forth. Morgan Stanley also trending higher to the point that you're making here. That net new money, that's really the biggest game in town here. Compensation costs are significantly up, $300 million in severance costs, mostly though at the institutional business where the ROEs are the low single digits, mid-single digits, more than 30% in ROTC over at that wealth management unit. Just stunning, stunning, stunning returns. I do just want to point here at PNC, because of that big divergence you're seeing between the biggest of the big and the mid-sized banks, that decrease you're seeing in net interest income guidance for the year, that drop off, you're seeing it in the stock. At the end of the day, clearly pressure on costs. So long as these banks can keep bringing in money to exceed that increase in costs is where you're seeing the stock story start to play out. PNC, though, was actually trading at a higher book value, price to book value, than you saw at Bank of America, which is actually this morning still below its book value.
Shanali, thank you. With the exception of PNC, so far not so bad for the big players on Wall Street. Goldman, the last to come. Shanali's going to give you a preview of that in just a moment. Coming up in the morning calls and later, and of course, Julian Emmanuel weighing in on the bank earnings, and we'll catch up with Erica Najarian of UBS. From New York, this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Equity softer, let's get you some morning calls. Truist downgrading Norwegian Cruise to hold, seeing limited upside following the stock's massive outperformance. Evercore upgrading Pinterest, pointing to strengthening fundamentals. And Odeon Capital upgrading Citi, saying it's the only bank that's clearly benefiting from higher interest rates. Coming up next, the financials in focus. After results from Bank of America and Morgan Stanley, Erica Najarian and Julian Emmanuel at the opening bell.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
24 seconds away from the open and bow this morning. Good morning to you all. Equities right now negative 0.1% on the S&P. Coming into Tuesday after the close on Monday at highs we have not seen going back to April of 2022. Equities on the Nasdaq down by about 0.2%. Earnings so far this morning, not bad. Retail sales in America just about okay. There's your opening bow. Switch at the board and get to the bond market. Yields shaping up as follows: down 4 basis points on a 10-year, 376.58. Yields tracking lower over the last couple of weeks, particularly last week after the CPI report, PPI as well, and a bunch of other disinflationary reads. On a 2-year, we're down 4 basis points to 470. My attention over the last week, though, on the euro. The euro against the dollar. 8 consecutive days coming into Tuesday of euro strength against the weaker dollar, 112.31. You make it day 9. That's the longest streak going back to 2004. Right now, just slightly negative on that currency pair by 0.04% at 112.31. Right now, about 40 seconds into the session, we're negative 0.1% on the S&P. Let's wrap it up for you on the Nasdaq. We're down by about 0.2. The sector to watch at the open, the financials. Bank of America, Morgan Stanley reporting better than expected earnings as a result of higher interest rates. Katie has more. Hey, Katie.
And you're seeing that rally build as the bell rings. If we focus on Morgan Stanley again, we know that trading revenue was a disappointment. We know that deal making was down. It's been a very tough environment. But if you look at the shares, what's cushioning the blow here is that record wealth management revenue really delivering a beat there. You can see that's being reflected in the shares, currently up about 2%. Schwab, a really interesting story. Deposits did fall in the second quarter to the tune of 7%, but less than feared. Total deposits clocked in at about $304 billion. The estimates had been for $298 billion. Remember, it was fears over those fleeing deposits that really punished shares in March in particular, but you're seeing that relief now. Shares still down about 30% for 2023. And I want to finish on Morgan Stanley here because you are seeing a little bit of a lift, or rather Bank of America. You can see that the shares are rising after trading gains across fixed income, across equities, really helped deliver that second quarter profit beat. Brian Moynihan saying that all businesses performed well, John.
Katie, thank you, including, as you say, trading, sales and trading at B of A, the first half, the best in more than a decade. This is what the CEO, Brian Moynihan, had to say. We continue to see a healthy U.S. economy that is growing at a slower pace with a resilient job market. Shanali has more for you. Hey, Shanali.
The job market, especially at the banks, John, because if you take a look at it, some of the costs that the banks really took in were unfortunately tied to severance. That severance was highly weighted, according to Morgan Stanley's breakdown, of $300 million in that institutional securities business where trading and investment banking and advisory fees were under pressure. There are green shoots that can show you that perhaps some of this job pressure on Wall Street can start to ease because you're seeing underwriting, particularly at Morgan Stanley, start to tick higher in equity and debt underwriting, and Bank of America is also showing you that each of those business lines, including advisory, have beaten expectations. Now again, they have fallen dramatically over the last year or so, but to the point you're making, even in sales and trading over at Bank of America, one of the best first halves in the bank's history, which bodes well for the job force. Now, what they're telling you, what Bank of America, Morgan Stanley is telling you, is that they can bring in more money here, especially given their wealthier client bases, that they can offset the costs that they're taking into investing into these businesses. So let's see what this means in terms of returns for the rest of the year, because certainly they have been under pressure and certainly costs are high. But for now, they're bringing in the money.
Shanali, you pointed this out a little bit earlier this morning after the release. When a bank like Bank of America says the consumer is doing okay, am I getting a read on the U.S. consumer or just a read on the customer at Bank of America?
This is why there has been such a big flock to the big. Now, the Bank of America FICO score has inched higher over the last several years, now above 770. That is a very limited base of consumer there, John. And remember, when you're looking at the biggest banks, Bank of America, JP Morgan, it is credit cards. Citigroup, it's credit cards that is making them money. How much more steam is really there to leverage up on credit cards? The spending at Bank of America is mostly on travel and entertainment, as you would expect after a pandemic, but can you keep on spending money on $1,500 airplane tickets to Europe? I don't know how long that goes out for.
That felt personal, Shanali. That felt very personal. I wanted to say, 1:30 Eastern Time, you're going to be sitting down in conversation with James Gorman, the Morgan Stanley chair and CEO. Is this about the earnings or about the what next at the top of that bank?
It's about the future. Bank of America, Morgan Stanley, a lot of these capital rules are coming to those fee-based businesses and the trading desks where value at risk has been rising over the last couple couple of years at each of these banks. You don't bring in the money without taking on that risk. And the regulators are telling you they want you to make less money.
Sonali, looking forward to this. James Gorman, Chairman, CEO, Morgan Stanley, 1:30 Eastern Time, sitting down in conversation with Bloomberg's Sonali Basak. Sonali, thank you. Looking ahead to Goldman Sachs earnings tomorrow as well. We'll wrap up the big banks on Wall Street tomorrow morning. Looking forward to doing so. Let's stick with the financials. Odeon Capital upgrading shares of Citi, writing this. While interest rates may be close to the peak in this cycle, they are not expected to drop meaningfully. Citi benefits from higher rates, unlike many of its peers. We raise our rating on Citi to buy from hold. Plenty of research out there. UBS's Erica Najarian weighing in on Bank of America's latest results, saying this is clearly not going to be a beat and raise quarter like for JP Morgan, but the stock has already more than reflected this performance gap all year and has not traded up into the print. For any sustainable momentum, it's critical for Bank of America to be clearer on its net interest income path beyond the third quarter of 2023 on its call today. Erica Najarian joins us right now. Erica, have you had that clarity from that bank this morning?
Yes, indeed, and I think that's what's pushing the stock higher. So Bank of America said that net interest income is going to trend higher than what consensus has for both the third quarter and the fourth quarter. And honestly, that was a big fear in the market. So when you piece that together with a significant outperformance in sales and trading and investment banking, I think that's why you're seeing, significant tailwinds in the stock this morning.
Of the banks you cover, Erica, falling under your coverage, are higher interest rates helping these names or hurting them? There was a belief coming into this quarter that maybe we'd start to see a little bit of pain emerging as they start to pass on interest to depositors. Are you seeing much of that at all beyond Bank of America?
I still think you're seeing the best of the lot in terms of results. So if we think about these net interest income prints from JP Morgan, from Wells Fargo, from Bank of America, and honestly, to a lesser extent, Citigroup, they're showing you the power of strong, scaled core deposit franchises. Think about the deposit accounts that you and I have where our paychecks come in and our mortgages or our rent payments come out. Those hardly move. And those banks have significant scale in those types of deposits, including the types that corporates similarly have to manage cash flows. And as we hear from more regionals for the duration of the week, I think you're going to see a little bit of a more painful pinch on deposit costs than we've seen so far.
Is that a distinction you draw between, say, B of A and PNC this morning?
Honestly, I think PNC is going to be the best of the regional lot, but indeed, you can see the starting point from what to expect for regional banks in that PNC did lower its net interest income guide for the rest of the year, and B of A had, provided one that's above expectations. So yes, I think that's sort of the tip of the iceberg in terms of what to expect from regionals as it relates to deposit costs and deposit cost pain.
Erica, I know you've got to run, but can we touch on the bad news we didn't get, which was on credit? There was a big focus coming into the quarter about maybe provisions for credit losses increasing by a big amount, that maybe that pain would start to come to the surface. Have you been happy with what you've seen so far?
So let's look at the results from Synchrony, which is considered to be a little bit more of a non-prime lender. So I think you were talking with Sonali about the prime consumer at Bank of America, the prime consumer at JP Morgan. Well, the credit at Synchrony was also a little bit better than expected. So that shows you the strength of the consumer. That being said, if you look underneath the surface in terms of results, you are seeing deterioration in commercial real estate. So I think the takeaway here on credit is, commercial real estate is deteriorating as expected, and it's been talked about since March ad nauseum. The consumer remains strong, and corporate America also continues to remain strong.
Erica, thank you for being with us today off the back of those earnings. Thank you. Erica Najarian there of UBS on Bank of America on PNC. Another banking environment right now with those stocks doing okay for Bank of America, for Morgan Stanley. PNC just a little lighter, softer, lower in early trading. Evercore's Julian Emmanuel highlighting the muted move that you've seen in bank stocks over the last week off the back of better than expected results. He said this: initial reactions reinforce the notion that a high bar has been set. Today's trading will help shed light on whether the indifferent reception was a preview for the 2Q earnings season to come. Julian, I'm pleased to say, joins us now. Julian, is it a preview or not?
Well, what you're seeing on the screen today is really much what we think is going to govern the entire earnings season, is that you've got a number of stocks reporting a different interpretation on their earnings, mostly good, but stocks moving their own way. And if you look at the financials as a group over the last several months, the dispersion of performance is absolutely extraordinary. And again, history tells us we should be pleased by strong financial results, but it doesn't really seem to be moving the market material.
Well, that's what I wanted to build on. You know the question you get asked, I get asked it. I asked the question myself, can this rally broaden out? Can it, Julian?
Well, it started to, factually. Our call in taking our price target up in June was we thought it would move towards more value, smaller cap. And in fact, we have seen that. But the question is that in the environment, are we getting to a point where perhaps there is a little bit of complacency setting in? And that's a question that we have simply because when you look at the last month or so, we've seen volatility start to bottom and rise gently in places like the NASDAQ as that market has risen a lot. And when we've seen that movie before, it's really tended to usher in corrections.
Julian, you were at 44.50, I believe, when you upgraded that price target. It sounded almost bullish a little bit back then. It's not anymore. We're at 45.21 on the S&P 500. Julian, are we experiencing a mount up so far this year? Would you call it that? Would you go that far?
Well, so, John, as you know, it's literally almost a strategist short squeeze, is that our price target of 44.50 basis the ones that are published in Bloomberg is actually one of the higher ones. And I think the fact is that what we've failed to realize as a group in not being sufficiently bullish on the entire year is this effect of the extraordinary stimulus of 2020 and 2021 and the start of 2022. Even though we've had historic tightening, it hasn't been enough to derail the economy. We do think that's sometime in the future. Ed Hyman's calling for a recession for late this year and early next. But again, what we've seen from markets from time to time, and actually more frequently since the financial crisis, is that markets continue to move higher until right before the economy turns.
Julian, this is the challenge, I think, for anyone out there at the moment. In the market, out the market, in cash, in tech, riding those names high, whatever. Even if you believe that inflation reaccelerates later this year, Citi does. Even if you believe that we haven't seen the end of sticky inflation, Jim Bianco moments ago saying he doesn't think we have. Is that something you want to fight? Mohamed El-Erian was on the show in the last week or so, back on Friday, and I've talked about this a few times this week already. He said this soft landing narrative is just something you do not want to fight. Is that something you see just persisting through this summer, Julian, just tactically speaking?
The phrase "do not want to fight" is probably apt. What we're recommending is you stay fully invested, giving you a ticket to quote unquote stay on the bus because of the interest rate structure that we have and because of the volatility structure. So you can actually take out insurance that doesn't really cost anything and you don't start to degrade your performance until 10-15% higher in selected names. It's very difficult for, the bears are close to capitulating and the bulls are seeing some warning signs that, again, we're very, very extended.
Julian, can we just finish on volatility? I remember a wise man, I think he was at a Swiss bank at the time, took me out for lunch and we had a long conversation about vol. You remember that conversation, late 17, early 18, and you were warning about what was taking place. You got any warnings now, in any way, shape or form, what's happening on that front?
Well, it's the one thing I alluded to earlier with stocks and volatility rising, but it actually, the funny thing about this market, it has been fantastic for stock pickers, and that's reflected in correlations, which have driven the volatility, but correlations are at the lows of the last 2 decades, a low that we saw at the end of 2017, just before that event, Volmageddon, in early 2018, which is why we're saying stay invested, but stay hedged because the market affords you that. But again, it doesn't kill the concept of potentially making new all-time highs in the next 12 months. It just potentially derails that, making it a later rather than sooner idea.
Grilled octopus at a Greek restaurant. Julian, that was a good time. We should do that again. It's good to see you. Julian Emmanuel there of Evercore on comparisons going back to early 2018 and some of the things we're seeing develop right now on the screen. On the S&P 500, we're about 14 minutes into the session, just about turning positive on the NASDAQ. Slightly negative this morning. On tech, coming up, the Biden administration looking to restrict tech investments in China.
Well, first of all, I want to say that what we're doing is not tit for tat. What we're doing is putting in place controls that are designed to protect U.S. national security.
From Washington, D.C., Anne-Marie, up next.
Breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal is the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Well, first of all, I want to say that what we're doing is not tit for tat. What we're doing is putting in place controls. I explained to my Chinese counterparts that if we go forward with these, they would indeed be narrowly targeted. They would focus on a few sectors, in particular semiconductors, quantum computing, and artificial intelligence. We want to make sure if we do this that we get it right, and we've been working on the details.
The United States planning to curb China-bound tech investments. Officials focusing on narrow restrictions for cutting-edge tech like chips, quantum computing, and AI. Bloomberg's Anne-Marie has more. AMH, what's the latest?
Well, the latest, Jonathan, is that this outbound investment executive order the administration has been working on for months, or actually years, given the fact that Jake Sullivan called for this more than 2 years ago, it is going to be narrow in its scope, likely will be targeting just some of these new investments, and it's not even going to come into place until next year, 2024, because after this, it goes through a hearing process before the rules and controls actually go into place. And yesterday, in my conversation with the Treasury Secretary, she really gave some color about this. She said it would not be broad controls, and in her opinion, she said it would not fundamentally impact the investment climate in China. So obviously, this would be good news to some of these chip executives like Intel and Qualcomm, these CEOs who were at the White House yesterday in this last-ditch effort to really lobby the White House to not go beyond some of the controls in place. But it's going to be very difficult for the China hawks in Washington, D.C., who want to see even more broad scope controls about investing in China.
Anne-Marie, thank you, and fantastic work over the last 24 hours for Secretary Yellen, just pushing this story forward together with the team down in Washington. Let's stick with tech. The Microsoft Activision deal might take longer than expected. Bloomberg learning the $69 billion sale is unlikely to close by today's deadline as the companies continue seeking final regulatory approvals. Ed Ludlow has more for you. Morning, Ed.
Yeah, good morning, Jonathan. Bloomberg sources tell us that both parties are working towards getting this deal closed. We're tracking today, July 18th, because in the original merger agreement, there was a provision that said that if the deal was not completed by the July 18th deadline, Microsoft would owe Activision $3 billion and Activision would have the right to walk away. What sources told me last week was there is no intention for either side to let that happen. There are a number of avenues that they can go down. 20 hours ago, the UK Competition Appeals Tribunal put a stay on the original veto that the CMA had put in place, allowing the CMA and the parties to go back and find some remedy, some kind of compromise. And as we've reported, Jonathan, that compromise might be that Microsoft and Activision sell the UK cloud gaming rights to a third party. That would allow them to move forward. So that's where we're at. We're unlikely to close the deal today, July 18th, according to sources. But the regulatory avenues have opened up to allow a solution to happen in the UK, which is the final hurdle. It could be days, but they are working to get that deal closed.
Ed, thank you, mate. Ed Ludlow there on the latest on that deal. Busy couple of days coming up for Ed Ludlow, Caroline Hyde and the team of Bloomberg Technology as we start to get some earnings from the likes of Netflix and Tesla tomorrow after the close. On to next week, Alphabet, Microsoft, Meta, the usual names, and on to early August when you hear from the likes of Apple. Let's get you some sector price action. We can do that with Katie. Hey, Katie.
Hey, John. Well, the S&P 500 pretty much flat right now, but if you look under the hood, it's a little bit more interesting. You have 7 sectors in the green right now, 4 in the red. Leading the way to the upside, it's energies, it's utilities. On the bottom, though, you have big tech, which is why we're fighting here around that unchanged level. I want to focus on financials, though. That sector currently up about 0.7%. If you look over the past 30 days, it's putting together a pretty nice rally, up about 6%. But then you compare that to the overall benchmark, and still, that's a deep hole to climb out of for the banks.
Katie, thank you. Next stop for the banks, it's Goldman Sachs. In the bond market right now, yields are lower by 3 or 4 basis points on a 2-year, 470. On a 10-year, down 3 basis points to about 377. You can call it 378. One eye on the euro throughout the whole of this session. 8 consecutive days of euro strength against the US dollar. Will it become 9? Right now, we're negative by 0.1% on that currency pair at 112.23. Up next, your trading diary.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
25 minutes into the session, just about positive on the S&P 500 by 0.05%. You slice and dice the S&P, look across the sectors, it's tech underperforming, captured by the Nasdaq down by 0.55%. Financials doing okay, following results from the likes of Morgan Stanley and Bank of America. More financial earnings still to come. Let's get to the trading diary. Before we get there, the politics. President Biden holding a bilat with his Israeli counterpart at 1:15 Eastern Time. More bank earnings. Remember Western Alliance, big focus on the regionals over the last 3 months. They report results after the closing bell, followed by Goldman Sachs tomorrow morning, Zions Bancorp and First Horizon. We'll also get earnings tomorrow after the close from Netflix and Tesla, and then we'll round out the week with more results on Friday from Fifth Third, American Express, and a whole lot more. From New York, that rounds out the morning for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Be
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Markets
with Paul Sweeney.
I'm looking at just brutal losses in the fixed income market. What's happening in the commercial real estate biz? Do we have a problem? How big is it going to get? But it seems like people want a job, they can get a job. You can't have a recession in that kind of scenario, can you?
Breaking market news and insight from Bloomberg experts.
Banks have to either raise capital or shrink their balance sheet.
Pricing power remains strong.
The best way to predict what the Fed's going to do is think about what they should have done a year ago.
Jay Powell's never going to say never.
Bloomberg News breaking down all the market action out there.
This is Bloomberg Markets
with Paul Sweeney
on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. Madison Mills, Paul Sweeney here with you. We are streaming live on YouTube. You can go to YouTube and just check out Bloomberg Global News. You'll find us there. Coming up on the show, we're going to check in with these markets here. We're going to speak with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. We've got a Fed meeting coming up in a couple of weeks. We want to see about where the Fed is going to go one time or more in terms of rate hikes. So we're going to have that for you. Plus, we're going to check in with Kara Murphy, CIO at Kestra Investment Management. We want to get her call on these markets. But first, let's kick it off with John Tucker to get a Bloomberg Business Flash. John, what do you have for us?
All right, just to recap, I mean, this is having absolutely no impact on markets, but to recap the story that you guys were doing before the top of the hour, former President Trump saying he's been notified he's a target in the Justice Department's probe into efforts to overturn the election results in 2020. That means